On the morning of September 15, 2008, people arrived at work as if the world still understood itself. They took the subway into Manhattan. They bought coffee in paper cups. They stepped through revolving doors. They rode elevators upward through buildings made of glass, steel, debt, and confidence. Then the news moved across the screens. Lehman Brothers had filed for bankruptcy, the fourth largest investment bank in the United States. 158 years old, more than $600 billion in assets. Gone. Not merged quietly into a stronger institution. Not saved in a late-night government rescue. Not allowed to pretend until the market opened again. Gone into court. The filing was the largest bankruptcy in American history. For many people, the number was too large to understand. It belonged to a scale where money stops feeling like money and begins to feel like weather. But the consequences were not abstract. They moved through trading desks, pension funds, money market accounts, mortgages, layoffs, foreclosures, and ordinary kitchens where families would soon ask what had happened to their jobs, their savings, and their homes. That morning, the financial system revealed something it had worked very hard not to reveal. It was more fragile than it looked. The fragility had not appeared overnight. It had grown slowly. It had grown in mortgage brokers' offices. It had grown in suburban subdivisions. It had grown in rating agency models. It had grown in trading books. It had grown in short-term funding markets that most citizens never saw and almost no one outside finance understood. It had grown in the quiet belief that housing prices could not fall everywhere at once. That belief had a price. Lehman Brothers paid it publicly. The world paid it afterward. The collapse of Lehman Brothers is often described as a single weekend. The weekend when executives, bankers, lawyers, regulators, and government officials tried to find a buyer and failed. That weekend matters. It was the narrow bridge between panic and bankruptcy. But the real story is much longer. It begins not in September 2008, but in the long American habit of turning homes into finance. It begins with a firm that started far from Wall Street. It begins with cotton. It begins in Montgomery, Alabama in 1844 when Henry Lehman, a German immigrant, opened a dry goods store. He sold ordinary things: cloth, thread, tools, goods for a town built into the economy of the American South. His brothers Emanuel and Meyer joined him. The store became Lehman Brothers. Cotton moved through the region like money. Farmers brought cotton as payment. The brothers accepted it, traded it, and slowly learned that the movement of goods could become the movement of capital. The company shifted from merchandise to commodities, then from commodities to finance, from Montgomery to New York, from a store counter to the machinery of markets. Over the next century and a half, Lehman Brothers survived almost everything the American economy could produce. The Civil War, the Panic of 1907, the crash of 1929, the Great Depression, 2 world wars, inflation, recessions, market panics, mergers, changes in regulation, changes in technology, changes in the way money itself moved. Survival became part of the firm's identity. This is one of the quiet dangers of old institutions. They begin to confuse endurance with immunity. A firm that has survived many crises has proven something real. It has proven adaptability. It has proven institutional memory. It has proven that its name can outlive generations, but it has not proven it can survive anything. The difference between those two ideas is where collapses live. By the early 21st century, Lehman was no longer a dry goods store, no longer a cotton trader, and no longer a modest partnership. It was a global investment bank. It advised companies. It traded securities. It underwrote deals. It financed clients. It operated inside the fast, leveraged, interconnected world of modern Wall Street. Its employees worked in offices across continents. Its balance sheet was enormous. Its reputation was old. Its risk was newer than its name. To understand that risk, we have to enter the housing market before it broke. The early 2000s in America carried a simple public story. Home ownership was good. Houses were safe. Prices went up. A mortgage was not only a debt, it was a path into stability, status, and the American idea of progress. Politicians liked that story. Banks liked it. Mortgage brokers liked it. Home builders liked it. Families liked it. Investors liked it. It made nearly everyone feel that they were standing on solid ground, but the ground was being engineered. Mortgages were no longer mainly held by the institution that made the loan. Increasingly, loans were originated, bundled, sliced, rated, sold, insured, financed, and traded. The mortgage became an ingredient. A homeowner signed papers at a closing table. That loan could later become part of a mortgage-backed security. That security could be divided into tranches. Some tranches appeared very safe. Others carried more risk and higher yields. The payments from homeowners flowed through the structure like water through pipes. If the payments kept coming, the machine worked. If house prices kept rising, the machine seemed safer. If borrowers refinanced before trouble arrived, the machine looked better still. The financial system became very skilled at turning ordinary mortgage payments into complex securities. Complexity did not remove risk. It changed where risk appeared. Sometimes it hid it. Sometimes it spread it. Sometimes it made people believe the risk had been transformed into something safer because the structure looked mathematical. That was the first quiet problem. The second problem was the quality of the mortgages. Not every borrower was the same. Some had strong credit, stable incomes, and real capacity to repay. Others did not. Subprime mortgages were made to borrowers with weaker credit profiles. Some loans had adjustable rates that could rise sharply after an introductory period. Some required little documentation. Some assumed that refinancing would be available because house prices would keep increasing. In a rising market, weak lending can look stronger than it is. A borrower in trouble can sell. A borrower can refinance. A lender can recover because the house is worth more. Rising prices can cover many sins. Falling prices reveal them. That detail would matter later. The credit rating agencies played a central role. Investors around the world relied on ratings to understand securities they could not examine loan by loan. Many mortgage-related securities received high ratings. Some received the highest rating, AAA. Those three letters carried enormous power. They told investors that a security was very safe. They allowed institutions with strict investment rules to buy products tied to mortgages they did not fully understand. They made complex structures feel clean. The models behind those ratings depended on assumptions about default, assumptions about house prices, assumptions about correlations between regions, assumptions about how borrowers would behave. Assumptions can be reasonable. They can also become dangerous when everyone has an incentive to believe them. The public story was clean. The private reality was not. Mortgage originators wanted to make loans because loans could be sold. Banks wanted securities because securities could be packaged and traded. Investors wanted yield because safe assets paid less. Rating agencies were paid by issuers, creating conflicts that would later receive heavy scrutiny. Home buyers wanted access to houses. Home builders wanted buyers. Politicians wanted expanding home ownership. Everyone had a reason to keep the machine moving. The machine moved. Lehman Brothers became deeply involved in it. The firm was aggressive in mortgages and real estate. It owned mortgage originators, including BNC Mortgage, which specialized in subprime lending. It built exposure to residential and commercial real estate. It held mortgage-backed securities. It financed positions with borrowed money. It operated with high leverage, meaning a relatively small decline in asset values could threaten the firm's capital. Leverage is simple in principle. If a firm uses its own money to buy an asset, losses are limited by the amount invested. If it borrows heavily to buy more assets, gains can be magnified. So can losses. A small movement in the wrong direction can become large relative to the firm's equity. Leverage is not always reckless. Financial firms use it as part of ordinary business. But leverage requires confidence. Confidence from lenders, confidence from counterparties, confidence from markets, confidence that assets can be sold at reasonable prices, confidence that funding will be available tomorrow. When confidence leaves a leveraged firm, the mathematics can become brutal. The firm may not have time to wait for assets to recover. It may be forced to sell. Forced selling lowers prices. Lower prices create more losses. More losses create more fear. Fear removes funding. The loop closes. That loop was waiting inside Lehman. In 2006 and 2007, the housing market began to turn. The early signs did not arrive like a single alarm. They arrived as defaults, as rising delinquencies, as stress among subprime lenders, as falling confidence in mortgage-backed securities, as questions about whether the ratings had been too generous, as funds exposed to mortgage products began to wobble. In 2007, two Bear Stearns hedge funds heavily exposed to mortgage securities collapsed. That event was a warning. Someone had noticed. But noticing was not enough. The system still hoped the damage could be contained. Perhaps subprime was isolated. Perhaps housing weakness would remain regional. Perhaps sophisticated institutions had hedged their exposure. Perhaps the models would hold. Perhaps the market was only repricing temporarily. Hope can be very technical in finance. It does not always sound like hope. It sounds like liquidity. It sounds like temporary dislocation. It sounds like mark-to-market pressure. It sounds like containment. But beneath the technical language, the question was simple. What if the houses are worth less than the debts built on them? Lehman faced that question with increasing pressure. Its chief executive, Richard Fuld, had led the firm for years. He was known as intense, combative, loyal to the institution, and deeply identified with Lehman's survival. Under his leadership, the firm had recovered from past difficulties and built itself into a powerful Wall Street player. That history mattered. Fuld had seen Lehman threatened before. He had seen it survive. He had reason to believe in toughness. But toughness can become dangerous when the problem requires recognition more than resistance. The firm did raise capital. It did try to reduce some exposures. It did seek strategic options. But critics later argued that Lehman moved too slowly, marked assets too optimistically, and failed to confront the full scale of its real estate problem early enough. One number did not fit. The market value of mortgage-related assets was falling. The confidence in firms holding those assets was falling. But Lehman still needed investors, counterparties, and lenders to believe that its balance sheet was sound. That belief became harder to maintain. The collapse of Bear Stearns in March 2008 changed the atmosphere. Bear Stearns had been another storied investment bank. It depended heavily on short-term funding. When counterparties lost confidence, it could not continue. The Federal Reserve helped arrange its sale to J.P. Morgan Chase. The rescue prevented a disorderly bankruptcy. It also created a question. If Bear Stearns had been rescued, what would happen to Lehman? Markets began to test the answer. Lehman's stock came under pressure. Credit default swap spreads widened, showing rising concern about the firm's creditworthiness. Rumors moved quickly. Funding became more fragile. The company announced losses. It raised capital. It tried to reassure the market. But reassurance becomes less effective each time it is needed. By the summer of 2008, Lehman was under severe strain. The firm searched for strategic solutions. There were discussions with potential investors and buyers. Korea Development Bank considered an investment, but no deal was completed. Other possibilities were explored. The problem was that any buyer had to understand and accept the risks on Lehman's balance sheet. That was difficult. The assets were hard to value. The market was deteriorating. The firm needed confidence quickly. The weekend of September 13 and 14, 2008 brought the crisis to its narrowest point. Lehman needed a rescue before markets opened. Officials and bankers gathered in New York. Potential buyers were considered. Barclays was interested, but British regulators would not approve a transaction without shareholder approval and without guarantees that were not available. Bank of America considered Lehman, but ultimately moved toward Merrill Lynch instead. The U.S. government was unwilling or unable to provide the same kind of support that had been used in the Bear Stearns rescue. The conditions were different. The legal authorities were contested. The politics had changed. The appetite for another Wall Street rescue was low. The weekend became a slow narrowing of exits. By Sunday night, there was no buyer, no government backstop, no private solution, no time. The moment of no return had arrived. Lehman Brothers filed for bankruptcy. The filing did not merely end a firm. It changed what everyone thought was possible. Before Lehman, many market participants believed that a major investment bank might be rescued if its failure threatened the system. After Lehman, that belief was broken. The break moved through markets with astonishing speed. Money market funds came under pressure after the Reserve Primary Fund, which held Lehman debt, broke the buck. Commercial paper markets froze. Banks became afraid to lend. Counterparties questioned each other. Credit tightened. The crisis spread from Wall Street into the broader economy. The financial system, which had looked abstract to many people, entered ordinary life. Companies could not fund operations as easily. Consumers lost confidence. Housing fell further. Unemployment rose. Families lost homes. Savings declined. Retirement accounts shrank. The crisis became a recession that would shape politics, careers, and trust for years. Lehman became the symbol because it was the institution allowed to fall all the way. Not the only guilty firm, not the only reckless institution, not the only holder of bad mortgage risk, but the visible failure, the name on the bankruptcy filing, the employees carrying boxes, the screen showing a stock that had once represented confidence and now represented absence. The collapse also left a long legal and investigative afterlife. The bankruptcy examiner's report by Anton Valukas later examined Lehman's practices in detail. One issue became especially famous: Repo 105. Repos, or repurchase agreements, are a common form of short-term financing. A firm sells securities with an agreement to repurchase them later. Economically, such transactions often function like secured loans. Lehman's Repo 105 transactions allowed the firm to temporarily move assets off its balance sheet near reporting dates, making leverage appear lower. The examiner concluded that these transactions gave a misleading picture of the firm's financial condition. The phrase became shorthand for how a firm under pressure can use technical accounting to manage appearances. Repo 105 did not cause the entire collapse by itself. The deeper problems were leverage, real estate exposure, market panic, and funding fragility. But Repo 105 mattered because it showed how important appearance had become. When a firm must manage not only its risks but the visibility of its risks, the danger is already advanced. The public story was solvency. The private reality was strain. The aftermath of Lehman forced regulators and policymakers to rethink the structure of finance. Capital requirements became stricter. Stress testing became more important. Large institutions faced new oversight. Derivatives markets received new rules. The Dodd-Frank Act was passed in 2010. The phrase "too big to fail" became permanent in public debate. But reforms arrive after damage. They are built from what the previous system failed to prevent. For ordinary people, the Lehman story was not mainly about capital ratios. It was about jobs, homes, savings, trust. It was about discovering that decisions made in distant financial rooms could travel into ordinary life with devastating force. It was about the realization that risk hidden inside complexity is still risk, and debt hidden behind structure is still debt. Lehman Brothers began with three brothers in cotton. It ended with court filings, asset sales, investigations, and a world trying to understand how much had been built on the assumption that home prices would keep rising. The cotton was long gone by then. The dry goods store was gone. The old partnership culture of Wall Street was gone. What remained was a name, a balance sheet, and a warning. A firm can survive many storms and still build itself too close to the next one. The markets are quiet now. The old Lehman building on 7th Avenue became part of another institution's story. The employees dispersed into other firms, other careers, and other lives. The mortgages were resolved one by one across years of foreclosure, modification, payment, loss, and slow recovery. The economy stabilized, but not without scars. Some scars became policy. Some became political anger. Some became family memory. Some became a permanent suspicion of people who said the system was safe because the model said so. The file closes on the morning of September 15, not because that was where the story began, but because that was where the illusion ended. The screens were on. The coffee was still warm. The employees were still arriving. The institution was already gone. To understand why the institution could disappear so quickly, it helps to slow down inside the mortgage machine. The machine began with something familiar. A person wanted a house. A lender offered a mortgage. The borrower promised to make monthly payments. In an older banking world, the lender might have held that mortgage for years. The bank would care deeply about whether the borrower could repay because the loan would remain on its books. Risk stayed close to the person who created it. By the early 2000s, that world had changed. Many lenders originated loans to sell them. Once the loan could be sold, the lender's incentive shifted. The lender still cared about quality, but not in the same way. Volume became important. Fees became important. Speed became important. The mortgage became raw material for Wall Street. This is one of the quiet transformations behind the crisis. The American house became an input. Not only a place to live, not only a family asset, an input for securities. A mortgage could be placed into a pool with thousands of other mortgages. The pool could be structured so that different investors received different claims on the payments. The safest tranches would be paid first. The riskiest tranches would absorb losses first. In theory, this structure made sense. It allowed risk to be divided. It allowed investors with different appetites to buy different pieces. It allowed capital to flow into housing. It could lower borrowing costs. It could distribute risk across the system. But the system depended on the quality of the inputs and the truth of the assumptions. If the loans were weaker than expected, the structure was weaker. If house prices fell together, the structure was weaker. If borrowers defaulted in correlated ways, the structure was weaker. If investors relied too heavily on ratings, the structure was weaker. If the firms holding the securities borrowed too much against them, the structure was much weaker. The machine looked diversified, but diversification can fail when the same assumption sits under many assets. The assumption was that housing was safe enough. Not perfectly safe, but safe enough. Safe enough because prices had risen for years. Safe enough because regions were thought to differ. Safe enough because borrowers could refinance. Safe enough because the securities were structured. Safe enough because the models said losses would be contained. Safe enough because the rating agencies put powerful letters on the bonds. Safe enough because everyone else was participating. That last form of safety is the most dangerous, the safety of consensus. When many institutions believe the same thing, each institution can mistake the belief of others for independent evidence. A bank buys because investors demand the product. Investors buy because rating agencies approve the product. Rating agencies approve because models show safety. Models show safety because they are built on historical data from a period before the stress. Mortgage brokers produce more loans because Wall Street buys them. Wall Street buys more because investors want yield. The loop creates its own confirmation. Everyone can point to someone else. The borrower signed, the lender originated, the bank structured, the rating agency rated, the investor bought, the insurer wrote protection, the regulator watched, the market priced. No single participant has to feel fully responsible for the whole machine. That diffusion of responsibility is one reason complex systems fail so quietly. Lehman was not outside the machine. It was inside it. The firm bought, sold, structured, financed, and held mortgage-related risk. It had a large fixed-income business. It had real estate exposure. It believed it understood the market. On Wall Street, understanding and exposure often grow together. The more a firm knows a market, the more comfortable it becomes taking risk in that market. The more money it makes, the more the market seems to confirm the knowledge. Success becomes evidence. But success in a rising market can be misleading. It can reward leverage. It can reward optimism. It can reward weak discipline. It can make risk managers look too cautious and traders look insightful. It can make a cycle look like skill. Lehman had skill. That is important. The firm was not staffed by fools. It was staffed by highly educated, intensely competitive people who understood many parts of finance very well. But intelligence does not remove exposure. It can even increase confidence in exposure. A firm can be smart enough to build a dangerous position and not humble enough to reduce it in time. The mortgage boom rewarded firms that moved aggressively. Lehman moved aggressively. It expanded in mortgage origination and real estate. It accumulated positions in commercial real estate, leveraged loans, and mortgage assets. It reported strong profits during the boom. The market rewarded the performance. Employees were paid. Executives were praised. Shareholders saw value. The machine seemed to work. When housing began to weaken, the first question was whether the weakness was temporary. Financial firms often resist recognizing losses because recognition has consequences. A mark on an asset is not merely a number. It affects capital. It affects confidence. It affects funding. It affects ratings. It affects compensation. It affects the authority of people who built the position. Marking an asset down can be an admission that the earlier story was wrong. That admission is hard inside a culture built on confidence. Lehman's culture was famously tough. Richard Fuld, sometimes called the gorilla of Wall Street, embodied that toughness. He had led Lehman through earlier crises. He valued loyalty. He projected defiance. There are moments when defiance saves a firm. There are moments when defiance prevents a firm from hearing the market. The crisis of 2007 and 2008 required both nerve and flexibility. A firm had to avoid panic. It also had to recognize reality. Too much panic could destroy confidence. Too much confidence could delay necessary action. The balance was narrow. Lehman struggled to find it. As mortgage assets weakened, the firm's leverage became central. A highly leveraged investment bank depends on continuous trust. It borrows short-term and invests in assets that may be harder to sell quickly. It uses repo markets and other funding arrangements. It deals with counterparties who can demand more collateral or step back if they become nervous. This structure can function smoothly for years. In calm markets, short-term funding rolls over. Assets are accepted as collateral. Counterparties believe the firm is sound. Liquidity appears abundant. But liquidity is not the same as capital. Liquidity is the ability to meet obligations as they come due. Capital is the cushion against losses. A firm can appear liquid until lenders refuse to roll funding. It can appear solvent until asset values fall far enough. In crisis, concerns about solvency and liquidity feed each other. If people think a firm may be insolvent, they withdraw liquidity. If liquidity disappears, the firm may become insolvent because it must sell assets quickly at distressed prices. This is the financial version of a crowd moving toward one exit. The exit may be wide enough in normal times. In panic, it is not. Lehman needed counterparties to remain calm. But counterparties were watching the same housing market. They were watching Bear Stearns. They were watching Lehman's stock price. They were watching credit spreads. They were watching rumors. They were watching every capital raise and every earnings announcement for signs of weakness. In modern finance, perception changes funding conditions before the final facts are known. This makes perception part of the crisis. If the market believes a firm is weak, the belief can help make it weak. That does not mean the belief is false. It means the belief becomes active. Lehman tried to maintain confidence. It announced plans. It sought capital. It discussed asset sales. It explored creating a separate vehicle for troubled real estate assets. The market remained unconvinced. One reason was the complexity of the balance sheet. Investors could not easily know the true value of assets tied to troubled real estate and mortgage markets. When a company is hard to value during a crisis, uncertainty becomes a discount. People assume the worst not because they know it, but because they cannot afford to be wrong. This is especially true for counterparties with short-term exposure. They do not need to prove a firm will fail. They only need to fear that it might. Fear is enough to reduce exposure. Reduced exposure worsens liquidity. Liquidity pressure increases fear. Again, the loop closes. The Bear Stearns rescue in March 2008 gave the market a temporary reference point. Bear had collapsed quickly after a run on its funding. The Federal Reserve supported a sale to J.P. Morgan Chase. The rescue suggested that authorities feared the disorderly failure of a major investment bank. It also suggested that shareholders and management could suffer even if the institution was saved. Bear's sale price was initially very low before being revised upward. The message was complicated. The system might be protected. Individual firms might not be. Lehman looked at Bear and saw danger. The market looked at Lehman and saw the next test. The months after Bear were therefore a countdown, though not everyone knew the length. Lehman reported a quarterly loss in June 2008, its first since going public in 1994. It raised capital. It tried to reassure investors that it had enough liquidity. But the loss pierced the old image. The firm that had survived and profited through many environments was now visibly wounded. Summer did not heal the wound. The housing market continued to deteriorate. Confidence remained weak. Potential investors looked closely and hesitated. Korea Development Bank's possible investment became a focus of hope, then faded. When that possibility failed, market confidence weakened further. This is another pattern in collapse. A possible rescue can support confidence while it remains possible. When it fails, the support turns into evidence of danger. If a sophisticated buyer looked and walked away, what did they see? The question spreads. The stock falls. Counterparties worry. Management has fewer options. By September 2008, Lehman had entered the corridor. The exits were narrowing. The firm announced another large loss and plans to spin off troubled assets. The market did not accept the plan as enough. Rating agencies threatened downgrades unless a strong solution emerged. A downgrade could have forced Lehman to post more collateral, increasing liquidity pressure. The clock was no longer measured in quarters. It was measured in days, then in hours. The weekend meetings at the Federal Reserve Bank of New York have become one of the central scenes of modern financial history. The participants were not gathered for ceremony. They were gathered because a major firm might not open on Monday. Government officials wanted a private sector solution. They did not want to provide taxpayer support. Wall Street executives were asked to consider how the system could absorb or rescue Lehman. Potential buyers evaluated the firm. The problem was the whole. Who would absorb the losses? Who would guarantee the assets? Who would take the risk of buying a balance sheet whose true value was uncertain in a falling market? Barclays appeared to be a possible buyer, but British regulators would not allow the bank to guarantee Lehman's obligations without shareholder approval. There was no time for that. Bank of America chose Merrill Lynch instead. The private solution failed. The government did not provide the backstop. By Sunday night, the institution that had survived 158 years had run out of road. The bankruptcy filing was not only a legal act, it was a signal flare. It told the market that the assumption of rescue had limits. It told counterparties that names, size, and history were not enough. It told investors that mortgage risk had traveled farther than they understood. It told ordinary people, though many would not know it until later, that the crisis was moving toward them. The Monday after Lehman was a lesson in interconnectedness. Financial systems are built from promises. Some promises are explicit contracts, some are assumptions, some are habits. A bank lends because it expects repayment. A fund holds commercial paper because it expects liquidity. A company issues short-term debt because it expects buyers. A trading desk deals with a counterparty because it expects settlement. A depositor keeps money in a fund because it expects the dollar to remain a dollar. Lehman broke many expectations at once. The reserve primary fund held Lehman debt and broke the buck, meaning its shares fell below $1. That event shook confidence in money market funds, which many investors had treated almost like cash. The shock moved into commercial paper, the short-term borrowing market companies use for ordinary funding needs. When that market froze, the crisis became less abstract. It threatened the ability of ordinary companies to finance payroll, inventory, and operations. This is how Wall Street risk enters Main Street. Not always through a direct line, through funding markets, through confidence, through credit availability, through layoffs, through falling asset prices, through households that suddenly cannot refinance, cannot sell, cannot borrow, cannot keep up. The machinery is technical. The consequences are human. In the days after Lehman, policymakers moved with increasing urgency. AIG required rescue. The government proposed what became the Troubled Asset Relief Program. The Federal Reserve expanded emergency facilities. The crisis forced interventions that had seemed politically impossible only days earlier. The decision not to rescue Lehman did not end bailouts. It changed their scale. This is one of the enduring ironies. Allowing Lehman to fail was partly intended to avoid moral hazard and limit government support. The panic that followed helped produce even larger interventions. History rarely gives clean choices. If Lehman had been rescued, critics would have said Wall Street had again been protected from its own risk. Because Lehman was not rescued, critics said the government allowed a preventable disaster. Both criticisms contain force. The real difficulty is that by September 2008, the system had already been allowed to become dangerous. The choice that weekend was not between good and bad. It was between different forms of damage. The damage had been prepared over years. That is why focusing only on the weekend can mislead. The weekend was the moment of failure. The causes were older. The older causes included a change in Wall Street itself. Lehman Brothers had begun as a family firm. For much of Wall Street's history, investment banks were partnerships. Partners owned the firm. Partners shared the profits. Partners also bore the losses. That structure did not make them virtuous. Old Wall Street had plenty of conflicts, arrogance, and risk. But partnership created a certain discipline. If the firm failed, partners could lose personal wealth. Risk was closer to the people taking it. Over time, many investment banks became public companies. Public ownership changed the incentives. Firms could raise more capital. They could grow larger. They could use public shares as currency. Employees could be compensated with stock. But risk also became more dispersed. Shareholders bore losses. Executives and traders could receive large compensation during good years. The downside was no longer felt in the same direct way as an old partnership. This change did not cause Lehman by itself, but it shaped the culture in which leverage grew. When a financial firm is public, quarterly performance matters, return on equity matters, market share matters, rankings matter, compensation depends on profits. Traders and bankers compete internally and externally. The firm wants to grow. If competitors are making money in mortgages and structured finance, staying cautious can feel like falling behind. Caution has an opportunity cost. During a boom, that cost becomes visible. The risks remain hidden. This is why restraint is so difficult in finance. The person who refuses the trade may look foolish for years before being proven right. The person who takes the trade may look brilliant until the cycle turns. By the time the cycle turns, the brilliant years have already paid bonuses, built reputations, and shaped the firm's strategy. Lehman was deeply competitive. It had long carried the mentality of an outsider. Compared with firms like Goldman Sachs and Morgan Stanley, Lehman had a more turbulent history. It had been spun out from American Express in 1994. It had fought for status. It had survived moments when others doubted it. That history produced pride. It also produced a need to prove. Richard Fuld understood that need. He had spent decades at Lehman. He was intensely loyal to the firm. He saw the company not as an abstraction, but as an institution that had survived humiliation and emerged stronger. This emotional connection mattered. Leaders who identify deeply with an institution can protect it fiercely. They can also have difficulty seeing when protection requires retreat. Retreat can feel like betrayal. Selling assets can feel like surrender. Raising capital on painful terms can feel like admitting weakness. Accepting a low-price deal can feel like destroying the legacy one spent a career building. In a crisis, pride becomes expensive. It can cause leaders to wait for better terms that never arrive. It can cause them to see market concern as misunderstanding. It can cause them to believe that survival through past crises proves survival through the present one. The present crisis was different because the market's trust in the assets themselves was breaking. Lehman could not simply outlast a rumor. It had to persuade the market about the value of assets tied to a collapsing housing system. That was a harder task. The housing boom deserves more patient attention because it was not experienced as recklessness by everyone inside it. For a family buying a house, the boom often felt like opportunity. Prices were rising, credit was available, neighbors were buying, television shows celebrated home renovation and property wealth. Mortgage brokers could offer loans that made ownership seem possible sooner than expected. A person who had been locked out of home ownership could be told that the market had finally opened. That message had emotional force. For lenders, the boom meant volume. For builders, it meant demand. For local governments, it meant development and tax revenue. For Wall Street, it meant product. For global investors, it meant yield attached to American housing, often wrapped in high ratings. The machine therefore had moral cover as well as financial incentive. It could be described as expanding homeownership. It could be described as democratizing credit. It could be described as financial innovation. Some of that language was sincere, some of it was self-serving. Often it was both. Business disasters frequently grow in that mixture. Pure cynicism is easier to identify. Mixed motives are harder. People can make money and believe they are doing something useful. They can ignore warning signs because the broader mission feels positive. They can treat critics as enemies of progress. In the housing boom, the positive story was powerful. More people owning homes, more liquidity in mortgage markets, more investment products for global savers, more profits for banks, more growth for communities. The negative story was quieter. Loans made to people who could not repay. Incentives separated from responsibility. Ratings that underestimated correlated risk. Securities that few buyers truly understood. Banks funding long-term risky assets with short-term borrowing. Regulators behind the curve. House prices treated as if gravity had been repealed. The positive story was public. The negative story was embedded. This is why the collapse felt sudden to many people, even though the risks had been building for years. The danger was not hidden in one secret room. It was distributed across ordinary transactions. A loan closing here, a securitization there, a rating model, a warehouse line, a repo agreement, a trading book, a board presentation, a risk report, a quarterly earnings call. Each piece seemed manageable. Together they formed a system that could not absorb the reversal it had discounted. Lehman's real estate exposure was especially troubling because it sat at the intersection of credit risk and market confidence. If the assets were worth close to Lehman's marks, the firm might survive with enough time and liquidity. If they were worth much less, the firm's capital position was weaker than stated. But in a crisis, the market does not wait calmly for perfect valuation. It prices uncertainty harshly. This is why hard-to-value assets can become fatal for leveraged institutions. The assets do not have to be worthless. They only have to be uncertain enough that lenders pull back. Lehman was forced to live inside that uncertainty. The company could say its marks were reasonable. Skeptics could say the marks were too high. Potential buyers could demand protection against losses. Government officials could refuse to provide that protection. Each side could have reasons. The firm needed certainty. The market saw fog. Fog can be deadly when funding is short-term. The role of short sellers also became controversial. Lehman executives and supporters sometimes argued that short sellers and rumors had attacked the firm. Short sellers bet that a stock will fall. In a crisis, they can become symbols of predation. It is true that rumors can harm a financial institution. It is true that market pressure can become self-reinforcing. But blaming short sellers alone misses the deeper issue. Short sellers did not create the mortgage exposure. They did not create the leverage. They did not create the funding dependence. They did not create the difficulty valuing assets. They reacted to weakness and, perhaps, acceleration is not the same as original cause. This distinction matters because collapsing firms often look outward for enemies. The market is unfair, the media is unfair, the shorts are unfair, regulators are unfair. Sometimes elements of those claims have merit. Markets can be brutal. Media coverage can simplify. Short sellers can amplify fear. Regulators can be inconsistent. But a firm with a resilient balance sheet can survive criticism. Lehman could not survive the loss of confidence because its structure made confidence essential. That was the deeper vulnerability. The firm's use of Repo 105 later became one of the clearest examples of appearance management. To understand why it mattered, we need to understand the importance of leverage ratios. Investors and counterparties wanted to know how much Lehman had borrowed relative to its equity. The higher the leverage, the thinner the cushion. If leverage appears lower at quarter end, the firm can look less risky. Repo 105 transactions allowed Lehman to temporarily remove assets from the balance sheet and use the cash to pay down liabilities, reducing reported leverage at reporting dates. After the reporting date, the transactions could be unwound. The examiner's report later described this as materially misleading. The technical details are complex. The principle is simple. The firm was under pressure to look less leveraged than it otherwise would have looked. This matters because the need to manage appearance is itself diagnostic. Healthy firms care about presentation. All companies do. But when presentation becomes a tool for managing existential concern, the company has entered dangerous territory. The question is no longer only what the risk is. The question becomes how much of the risk outsiders can see. In finance, trust depends on visibility. If outsiders begin to believe visibility is impaired, they demand more protection or withdraw. Repo 105 therefore became more than an accounting controversy. It became a symbol of the gap between reported stability and underlying strain. The examiner did not say Repo 105 alone brought down Lehman, but he placed it inside a broader picture of pressure, judgment, and disclosure. That picture remains one of the most important documents of the crisis. It shows a firm trying to manage its image while the ground beneath it deteriorated. The rating agencies also faced scrutiny after the collapse. They had played a central role in the mortgage machine. Their ratings made securities acceptable to investors who might not otherwise have bought them. When highly rated mortgage securities performed far worse than expected, the credibility of the ratings process was damaged. The problem was not merely mathematical, it was institutional. Rating agencies were paid by issuers whose products they rated. That structure created conflicts. If one agency was too strict, business could move elsewhere. The agencies used models that relied on historical assumptions. The housing market's national decline broke assumptions that had seemed safe. Investors who outsourced judgment to ratings discovered that a rating is not a guarantee. It is an opinion. An opinion can be wrong. When that opinion carries regulatory and market power, the wrongness can travel far. Lehman, like other firms, operated in a world built around those opinions. It structured products. It held assets. It relied on market acceptance of ratings. When trust in ratings weakened, trust in the products weakened. When trust in products weakened, trust in firms holding them weakened. The chain was long. Each link weakened the next. There were also regulatory gaps. Investment banks were not regulated like commercial banks. They did not have the same stable deposit base. They relied heavily on capital markets for funding. Their failure could still threaten the financial system. This combination was dangerous. They were systemically important without being protected and supervised in the same way as traditional banks. After the crisis, this gap received intense attention. but before the crisis, the structure had been allowed to grow. Financial innovation moved faster than the public framework around it. That pattern appears again and again in financial history. Markets invent, profits grow, complexity increases. Regulation adapts slowly. The system appears efficient until stress reveals the missing guardrails. Lehman fell through those gaps. The collapse of Lehman also changed the meaning of counterparties. In ordinary language, a counterparty is simply the other side of a financial transaction. In a crisis, counterparties become sources of contagion. If Lehman owed money or performance to another institution, that institution had exposure. If Lehman was on the other side of derivatives, trades, financing arrangements, or securities transactions, its failure created uncertainty. Who would be paid? When? How much? What positions needed replacing? What collateral could be seized? What contracts were frozen? The bankruptcy of a large financial firm is not like the closing of a shop. It is an interruption inside a network of promises. The network must be untangled. That untangling takes years. Lehman's bankruptcy estate became a vast administrative undertaking. Claims had to be resolved, assets had to be sold, disputes had to be litigated. Subsidiaries in different countries had to be handled. The firm did not simply vanish. It became a process. That process continued long after the public moved on. This is another quiet feature of collapse. The symbolic ending is fast. The legal ending is slow. The morning headline says gone. The estate keeps working. The public memory compresses the event. The paperwork expands it. For Lehman employees, the symbolic and practical endings colliding. Images of workers carrying boxes out of Lehman offices became part of the crisis iconography. Those images were powerful because they made systemic failure visible. A person with a cardboard box is easier to understand than a collateralized debt obligation. A lobby full of stunned employees is easier to understand than a repo market freeze. Human images carry what technical language cannot, but even those images simplify. Lehman employed tens of thousands of people. Some found work elsewhere quickly. Some were absorbed when Barclays bought the North American investment banking and capital markets businesses. Some careers were interrupted. Some identities were shaken. Working at a storied investment bank is not only a job, it is a status. It is a daily environment. It is a network. It is a way of understanding oneself. When the firm collapses, employees lose more than paychecks. They lose a story about where they belonged. This is true even in a hard industry like finance. People inside Wall Street firms may speak in numbers, trades, and deals, but they are still people. They still attach identity to institutions. They still feel shock when a name that seemed permanent disappears. Lehman had been a name for 158 years. That kind of age creates emotional weight. The bankruptcy made the weight fall all at once. The policy dilemma around Lehman remains one of the most argued questions in modern finance. Should the government have saved it? The question sounds simple because hindsight gives it shape. In the moment, it was not simple. Officials had to consider law, politics, market discipline, available collateral, public anger, and systemic risk. They had rescued Bear Stearns months earlier through a structure involving the Federal Reserve and J.P. Morgan Chase. That rescue had drawn criticism. Many people believed Wall Street firms had taken reckless risks and were now being protected from consequences. The phrase moral hazard became central. Moral hazard means that protection from consequences can encourage risk-taking. If a financial institution believes it will be rescued because it is too important to fail, it may take more risk than it otherwise would. If investors believe large firms will be protected, they may lend too cheaply. If management believes failure will be cushioned, discipline weakens. The argument against rescue has force. Capitalism cannot function if gains are private and losses are always public. Markets require failure. Risk must mean something. But the argument for rescue also has force. In a crisis, allowing one institution to fail can impose losses far beyond that institution. Innocent parties can be harmed. Credit can freeze. Employers can lose funding. Families can lose jobs. The public may pay anyway through recession rather than bailout. The choice is not clean. It is a choice between visible unfairness and invisible contagion. Rescue feels unfair because the institution survives. Non-rescue may feel principled until the consequences spread. Lehman forced policymakers into that tension. Some later argued that the Federal Reserve and Treasury lacked legal authority to rescue Lehman because the firm did not have sufficient collateral for a loan. Others argued that authorities could have found a way if they had chosen to do so. The debate continues because the answer affects how we understand the crisis. If Lehman could have been saved and was not, then the bankruptcy was a policy error. If Lehman could not legally be saved, then the failure revealed a gap in emergency powers. If Lehman should not have been saved, then the panic afterward was the cost of restoring discipline. Each interpretation carries a different lesson. What is clear is that after Lehman, the system became more frightened, not less. The market did not calmly absorb the lesson of discipline. It panicked. The panic revealed that Lehman was not an isolated firm whose failure could be contained. It was connected through funding, derivatives, investor psychology, and trust. AIG's near collapse followed almost immediately. AIG was not an investment bank. It was a giant insurance company with a financial products unit that had sold credit default swap protection on mortgage-related securities and other instruments. When those positions moved against it, and when collateral calls increased, AIG needed rescue. The government stepped in. The contrast was striking. Lehman was allowed to fail. AIG was rescued. To the public, this seemed confusing. Why one and not the other? To policymakers, the answer involved the particular risks of each institution, available tools, timing, and systemic consequences. But public trust does not thrive on technical distinctions during panic. People saw Wall Street firms being treated differently while the real economy deteriorated. Anger grew. The Troubled Asset Relief Program, or TARP, became one of the main vehicles for stabilizing the financial system. It was proposed in the desperate weeks after Lehman. The initial political reaction was fierce. Many citizens did not want taxpayer money used to rescue financial institutions that had helped create the crisis. The first vote in the House of Representatives failed. Markets fell sharply. The bill later passed. Capital was injected into banks. The system was stabilized over time. But the political damage was deep. Many ordinary people felt the rescue was designed for banks while homeowners suffered. This perception shaped the years that followed. It influenced distrust of institutions. It influenced political movements. It influenced how a generation understood fairness. The crisis was not only economic, it was civic. It changed the relationship between citizens and the people who claimed to manage the system. Lehman became part of that loss of trust. Even people who knew little about investment banking knew the name. It became a symbol of recklessness, complexity, and elite failure. Symbols matter because they simplify memory. The full crisis involved many institutions and many causes: Fannie Mae and Freddie Mac, mortgage originators, commercial banks, investment banks, rating agencies, insurers, regulators, borrowers, investors, global capital flows, low interest rates, financial innovation, political goals around home ownership. But the public cannot remember every mechanism. It remembers names. Lehman became the name. For households, the crisis arrived through channels that felt personal. A worker lost a job because demand fell. A family could not refinance because credit tightened. A homeowner owed more than the house was worth. A retiree watched a portfolio shrink. A graduate entered a weak labor market. A small business could not get a loan. A town saw foreclosures rise and property tax revenue weaken. The line from mortgage-backed securities to kitchen table anxiety was not always visible, but it existed. This is one reason financial complexity is politically dangerous. People suffer consequences from mechanisms they were never taught to understand. They are told the system is efficient, then the system fails. They are told rescue is necessary, then they see their own lives remain difficult. The result is resentment that may be unfocused but is not irrational. The crisis exposed a gap between expert language and public experience. Experts spoke of liquidity facilities, capital injections, systemic risk, collateral, and counterparty exposure. Households experienced unemployment, foreclosure, fear, and diminished trust. Both realities were true. They were not equally heard. Lehman's bankruptcy estate became one of the largest and most complex legal processes in history. The parent company filed in the United States, but Lehman operated through subsidiaries around the world. When the parent failed, the global structure fractured. Different jurisdictions handled assets and claims in different ways. Clients wanted their assets. Creditors wanted recovery. Employees wanted clarity. Buyers wanted pieces of the business. Barclays purchased Lehman's North American investment banking and capital markets operations in a deal approved quickly by the bankruptcy court. Nomura acquired parts of Lehman's operations in Asia and Europe. These sales preserved some jobs and some business functions, but they also showed that Lehman as an institution had been broken apart. The name survived mostly as a legal estate. The people, assets, and operations moved elsewhere. The old firm became a case. The bankruptcy judge's comments during the Barclays sale captured the gravity of the moment. He described Lehman as an icon caught in a tsunami that had overtaken the credit markets. The phrase was memorable because it balanced agency and circumstance. Lehman had made dangerous choices. It was also part of a larger wave. Both are true. Business history often becomes distorted when it chooses only one. If Lehman is treated only as a victim of a tsunami, the firm's own decisions disappear. If Lehman is treated only as a villain, the broader system disappears. The truthful account requires both. The firm made choices within a system that rewarded those choices until it punished them. The system created incentives that many institutions followed. Lehman followed them aggressively and entered the storm with too little protection. When the wave broke, it fell. The legal unwind also revealed how long consequences last after headlines fade. Years after the bankruptcy, claims were still being resolved. Recoveries were distributed, disputes continued, assets were sold. The estate became, in a sense, a shadow Lehman, no longer a bank, no longer a trader, no longer an employer in the old way, a machinery for allocating what remained. This is the afterlife of financial collapse. The living institution becomes a dead estate that still moves. It moves through courts, it moves through law firms, it moves through claims agents, it moves through reports, it moves through distributions. The old trading floor quiets. The paperwork continues. For regulators, Lehman became a case study in what had to change. Banks were required to hold more and better capital. Stress tests became a ritual of post-crisis supervision. Large institutions had to prepare living wills, plans for orderly resolution in case of failure. Derivatives markets were pushed towards central clearing and greater transparency. The Financial Stability Oversight Council was created to monitor systemic risk. The idea was to make the system less vulnerable to the sudden failure of one large firm. Whether reforms were sufficient remains debated. Financial systems evolve, risk migrates, rules close some doors and incentives open others. But Lehman changed the regulatory imagination. After Lehman, policymakers could no longer pretend that the failure of a non-bank financial institution would remain contained. They had seen the network. They had seen the panic. They had seen how quickly confidence could vanish. The phrase "too big to fail" became part of ordinary language, but it contains a paradox. If a firm is too big to fail, it is too dangerous to exist in that form. If it is allowed to fail, the damage may be too large. If it is rescued, the rescue may encourage future risk. The phrase describes a problem, not a solution. Lehman made the problem visible. It did not solve it. In the years after the crisis, banks became better capitalized. Some risky activities moved outside traditional banks. Shadow banking remained a concern. Markets recovered. Memories faded. New risks emerged. This is the rhythm of finance. Trauma produces reform. Reform produces adaptation. Adaptation produces new complexity. New complexity eventually requires new vigilance. The file is never fully closed. It is only placed nearby for the next cycle. Richard Fuld testified before Congress after the collapse. He defended aspects of Lehman's conduct and pointed to market conditions, rumors, and government decisions. The public mood was hostile. Executives from failed or rescued institutions became symbols of a broader anger. Congressional hearings offered a stage for that anger, but hearings cannot fully resolve a crisis. They can expose. They can dramatize. They can place people under oath. They can create records. They can satisfy a need for accountability, at least partially. But the deeper accountability in financial crises is often diffuse. Many decisions were legal. Many were profitable for years. Many were encouraged by incentives embedded in the system. When the system fails, assigning blame becomes necessary and incomplete. Lehman had leaders who made decisions. It also had competitors making similar decisions. It had regulators who missed dangers. It had investors who bought risk. It had rating agencies that blessed securities. It had borrowers who took loans, some responsibly, some not. It had a culture of home price optimism surrounding all of it. The crisis was a web. Lehman was the knot that snapped in public. The human need at the center of the mortgage machine was different from WeWork's need for belonging. It was the need for home. Home is one of the most powerful words in any economy. It carries shelter, identity, family, status, memory, and hope. When finance attaches itself to home, it attaches itself to something emotionally deep. That depth can make risk harder to see. A house feels solid. It has walls. It has a roof. It has an address. It can be touched. A mortgage-backed security tied to thousands of houses can inherit some of that feeling of solidity. But the security is not a house. It is a claim on payments. Those payments depend on borrowers, incomes, rates, prices, servicing, legal processes, and markets. The solidity of the house can hide the fragility of the finance built on it. This was one of the crisis's central illusions. Homes felt safe. The securities built from home loans felt safe. The firms holding those securities felt safe. Then home prices fell. The illusion broke upward through the structure, from borrower to loan, from loan to security, from security to bank, from bank to market, from market to economy. Lehman stood near the upper layers of that structure. When it fell, people finally saw how high the structure had been built. The long life of Lehman Brothers makes the ending feel almost geological. 158 years is longer than many countries' modern financial systems. It is long enough for a firm to pass through eras that barely resemble one another. The Montgomery store belonged to a world of ledgers, goods, local credit, and physical commodities. The 2008 firm belonged to a world of derivatives, global funding markets, electronic trading, and balance sheets that could change meaning with a shift in confidence. The name was continuous. The business underneath it was not. This continuity of name can create a false sense of continuity of risk. People say a firm survived the Civil War. They say it survived the Depression. They say it survived world wars. The statement is true. But the firm that survived those events was not always the same kind of organism. A dry goods store and a leveraged global investment bank do not fail in the same way. A cotton trader and a derivatives counterparty do not carry the same kind of risk. A partnership and a public investment bank do not have identical incentives. History gives prestige. It does not provide immunity. Lehman's movement from commodities into finance followed the broader movement of American capitalism. The country industrialized. Railroads expanded. Capital markets deepened. New industries needed financing. Investment banks connected companies with investors. They underwrote securities. They advised on mergers. They helped allocate capital. In the best version of the story, finance is a circulatory system. It moves resources toward productive use. It allows companies to grow. It allows investors to share in returns. It helps households borrow, save, and plan. But circulatory systems can also carry contagion. The same networks that move capital efficiently can move panic efficiently. That dual nature sits beneath the Lehman story. Finance is useful because it connects. Finance is dangerous because it connects. The more connected the system, the more carefully risk must be understood. By 2008, the system was connected in ways even sophisticated participants struggled to map. Lehman was not merely a company with assets and debts. It was a node in a network. It touched money market funds. It touched derivatives counterparties. It touched repo lenders. It touched hedge funds. It touched corporate borrowers. It touched global subsidiaries. It touched employees, landlords, clients, and regulators. When such a node fails, the failure is not contained inside the legal entity. It travels through the connections. This is why the bankruptcy was so frightening. No one knew exactly where all the consequences would land. Uncertainty became a force of its own. The mortgage product chain is worth following slowly because it shows how distance weakens responsibility. At the beginning is a borrower. The borrower may be hopeful, careful, confused, pressured, or speculative. They sit across from a broker or lender and sign documents. The loan has terms, interest rate, reset date, fees, documentation, monthly payment, penalties. In a healthy system, the loan matches the borrower's ability to repay. In a distorted system, the loan matches the market's appetite for product. Once the loan is originated, it may be sold. The originator receives money and can make another loan. The buyer pools many loans together. The pool is structured into securities. The securities are rated. They are sold to investors. Some are held by banks. Some are used as collateral. Some are placed into even more complex structures. At each stage, fees can be earned. At each stage, risk is described, transformed, or transferred, but transfer is not disappearance. The risk goes somewhere. If everyone believes it has gone somewhere else, the system becomes more fragile. This is what happened in parts of the mortgage boom. Originators did not always keep the risk. Structurers believed diversification and tranching managed the risk. Rating agencies believed models could estimate the risk. Investors believed ratings and yields compensated them for the risk. Insurers and derivative sellers believed they could price the risk. Banks believed hedges and funding markets could support the risk. The risk was everywhere and nowhere. Then house prices fell, and the risk came home. Lehman held too much of that returning risk. The firm's commercial real estate exposure also mattered. The housing crisis is often remembered through subprime mortgages, but commercial real estate and leveraged loans added pressure. Commercial projects depend on financing, occupancy, rents, and market confidence. When credit tightens, projects weaken. When property values fall, loans become harder to refinance. When investors demand higher returns, asset values decline. Lehman had invested in and financed real estate at a time when real estate looked strong. As the cycle turned, those positions became difficult to sell without recognizing losses. This created a trap. If Lehman sold assets, it might have to accept prices that confirmed market fears. If it held assets, investors worried the marks were too high. If it moved assets into a separate vehicle, investors asked who would bear the losses. Every path signaled weakness. This is what happens when a firm waits too long to reduce risk. The same action that might have reassured the market earlier can frighten it later. Timing changes meaning. A capital raise in calm times looks prudent. A capital raise in crisis looks desperate. An asset sale in calm times looks strategic. An asset sale in crisis looks forced. A governance change in calm times looks mature. A governance change in crisis looks like loss of control. Lehman faced this problem repeatedly. By the time it tried to reassure the market had begun interpreting reassurance as evidence that reassurance was needed. The firm could not easily escape the frame. The 2007 warning sign should have been louder. New Century Financial, a major subprime lender, filed for bankruptcy in 2007. Bear Stearns hedge funds collapsed that summer. BNP Paribas froze funds exposed to U.S. mortgage assets, citing the inability to value them. Credit markets began to show stress. These were not obscure signals. They were visible. But systems in motion are hard to stop. A bank cannot instantly unwind a large position without moving the market. A firm cannot easily abandon a profitable business line without internal resistance. Executives do not want to overreact to what might be temporary stress. Competitors may continue operating. Shareholders may punish caution if the feared disaster does not arrive. Employees whose bonuses depend on the business may resist cuts. Risk managers may warn, but business heads may argue that the risk is understood. The institution debates itself while the market changes. This internal debate is often invisible in the public record. By the time outsiders see the collapse, they may assume nobody noticed anything. Usually someone noticed something. The problem is converting notice into action. Action has costs. Early action can look foolish. Late action can be useless. Lehman was not unique in this. Many institutions saw pieces of the danger. Few saw all of it. Fewer still acted with enough force early enough. The crisis punished partial understanding. Fold's leadership style shaped Lehman's response. He had built a culture around loyalty and survival. Survival had become part of Lehman's mythology after its 1994 spinout. The firm had been counted out before. It had fought back. This kind of memory can be a strength. It gives people courage. It prevents panic. It creates identity. But institutional memory can also become misleading when the new crisis is structurally different from the old one. The lesson from past survival may be to stand firm. The lesson needed in the new crisis may be to retreat quickly. Those lessons can conflict. Lehman's leaders also had to consider shareholder dilution. Raising capital at a low price would hurt existing shareholders and signal weakness. Selling the firm at a distressed price would crystallize a painful outcome. Reducing assets aggressively could reduce future earnings if markets recovered. Every defensive move carried reputational and financial cost. This is why troubled firms often move too slowly. They wait for a better market. They wait for a better buyer. They wait for prices to recover. They wait for rumors to fade. Waiting feels rational because the alternative is painful. But in a liquidity crisis, waiting consumes the one thing that cannot be replaced: time. Lehman ran out of time. The final week before bankruptcy compressed years of accumulated risk into a few days. On September 9, reports that Korea Development Bank talks had ended sent Lehman's stock sharply lower. The market had treated the possible investment as a lifeline. When it disappeared, fear intensified. On September 10, Lehman announced a third-quarter loss of about $3.9 billion and plans to separate troubled real estate assets. The announcement did not calm investors. Instead, it confirmed the scale of the problem. Rating agencies watched closely. A downgrade would worsen collateral demands. Counterparties grew more cautious. The firm needed a transaction. By Friday, the situation had become urgent. The meetings at the New York Fed began under the shadow of Bear Stearns. No one wanted another disorderly collapse. No one wanted to reward failure. No one wanted to be responsible for a panic. The participants entered a room where every option was bad. That is important. The weekend was not a puzzle with a hidden perfect solution. It was a damage allocation exercise. Someone would bear losses. The question was who? Lehman shareholders, creditors, a buyer, other Wall Street firms, the government, the public through panic. There was no version in which the losses disappeared. The mortgage boom had created them. The weekend only decided where they surfaced. Potential buyers wanted protection. That was rational. No bank wanted to buy Lehman and inherit losses that could destroy its own balance sheet. Regulators wanted a private solution. That was politically understandable. Other firms did not want to fund a rescue that mainly helped a competitor. That was self-interested but predictable. The British regulators' refusal to allow Barclays to proceed without shareholder approval closed one major path. Bank of America's movement toward Merrill Lynch closed another. The weekend narrowed until bankruptcy became the remaining door. When Lehman filed, the legal action occurred before the emotional reality had settled. Employees woke up or arrived at work into a world already changed. Some learned from news reports, some from internal messages, some from the atmosphere in the building. The firm's European operations entered administration. Trading relationships were disrupted. Clients scrambled. Markets opened into uncertainty. The collapse had crossed from possibility into fact. The images from that day are now historical memory. Men and women leaving offices with boxes, reporters outside buildings, screens carrying the news, executives moving through legal and financial emergency. But the most important movement was invisible. Confidence moved. It moved away from assumptions that had held the system together. It moved away from the idea that large institutions would be protected. It moved away from money market safety. It moved away from unsecured lending. It moved away from counterparties whose exposure was not fully known. When confidence moves away from a financial system, the system becomes smaller very quickly. Credit contracts. Risk appetite falls. Institutions hoard liquidity. Everyone wants cash. Everyone wants safety. But if everyone wants safety at once, safety itself becomes scarce. The Federal Reserve and Treasury spent the following days and weeks trying to create safety, guarantees, liquidity facilities, capital injections, emergency programs. These measures were not designed to make people feel generous. They were designed to stop the run. The run was no longer only on one firm. It was a run on confidence. The crisis showed that modern finance can experience bank runs without lines of depositors outside branches. The run can happen in repo markets, in commercial paper, in derivatives collateral, in money market redemptions, in counterparties reducing exposure. It can happen electronically, institutionally, and invisibly. By the time the public sees the effects, the run may already be advanced. Lehman was the visible face of that invisible run. The global nature of the panic deserves its own space. Lehman Brothers was an American firm, but its failure was not an American event only. Its operations crossed borders. Its counterparties were global. Its securities and obligations touched institutions far from New York. The mortgage risk had also traveled globally. Investors in Europe and Asia had purchased products tied to American housing. Banks outside the United States had exposure to mortgage-related securities. Dollar funding markets connected institutions around the world. When confidence in American mortgage finance broke, the break moved through global channels. This is one reason the crisis became a global financial crisis rather than a contained U.S. housing correction. The world had bought pieces of the American housing story. When the story failed, the world held pieces of the loss. Globalization had made capital flow more freely. It had also made trouble travel more efficiently. The crisis exposed how dependent many institutions were on dollar funding. Banks outside the United States needed dollars for dollar assets and obligations. When dollar funding markets tightened, stress spread internationally. Central banks had to coordinate. Swap lines became important. The Federal Reserve provided dollar liquidity to other central banks so they could supply dollars to institutions in their jurisdictions. To ordinary citizens, this was obscure. To the system, it was vital. It showed that the crisis was not simply about bad American mortgages. It was about the global plumbing of finance. Plumbing is not glamorous, but when it fails, everything depends on it. The Lehman failure also revealed the importance of settlement and custody. Clients needed to know where their assets were. Trades needed to be resolved. Collateral needed to be identified. Subsidiaries needed to be separated from the parent. In the United Kingdom, Lehman's administration created severe disruption for clients and employees. The legal structures of global finance did not unwind neatly. They had been built for operation, not collapse. This is another recurring weakness in complex systems. They are optimized for normal conditions. They are not always designed for failure. Normal conditions reward speed, efficiency, and integration. Failure requires clarity, separability, and redundancy. The qualities that make a system efficient can make it fragile. Lehman was efficient within a world of fast funding, global trading, and interconnected claims. When it failed, that efficiency became confusion. The commercial paper market showed how quickly financial stress could reach ordinary companies. Commercial paper is short-term debt issued by companies to fund everyday needs. Large, credit-worthy companies use it because it can be cheaper and more flexible than other borrowing. Money market funds buy it because it is usually considered safe and liquid. When money market funds came under pressure after Lehman, demand for commercial paper weakened. Companies that had nothing to do with subprime mortgages suddenly faced a tighter funding environment. This is contagion. Not because every company made the same mistake, because they shared the same financial channels. A household may not know what commercial paper is, but if an employer cannot fund operations easily, the household may feel the result. Reduced hiring, delayed investment, layoffs, falling confidence. The chain from Wall Street to wages is longer than a headline, but it is real. The reserve primary fund breaking the buck was especially frightening because money market funds had been treated as almost cash-like. Investors expected $1 in to mean $1 out. When a fund broke that expectation, the idea of safety itself weakened. The government later moved to guarantee money market funds temporarily. This was an extraordinary step. It showed that panic had reached instruments used by ordinary investors, companies, and institutions for cash management. The crisis was no longer about whether one investment bank survived. It was about whether cash-like instruments would be trusted. Trust in cash-like instruments is foundational. If people doubt the safety of their safest assets, panic becomes difficult to contain. The government response therefore expanded because the crisis expanded. Each intervention answered a new area of fear. AIG, money market funds, commercial paper, bank capital, mortgage markets, consumer credit. The response was improvised, controversial, and enormous. It prevented collapse in some areas. It also left a legacy of anger. Many people saw institutions rescued while their own lives deteriorated. This anger became part of the post-crisis political landscape. It fueled distrust across the ideological spectrum. Some saw the crisis as proof that deregulated finance had become too powerful. Some saw the bailouts as proof that government favored elites. Some saw both. Lehman sat at the center of these interpretations because its fall marked the point when crisis became undeniable. Before Lehman, there was still space for minimization. After Lehman, minimization became impossible. The stock market fell sharply in the weeks that followed. Credit markets tightened, central banks cut rates, governments intervened, economic contraction spread. The unemployment rate in the United States rose sharply during the recession, eventually reaching 10% in October 2009. Millions of jobs were lost. Millions of homes entered foreclosure during the broader crisis period. Household wealth declined. The recovery was slow for many families. This slow recovery is important. Financial crises can end in markets before they end in lives. Stock prices may recover. Banks may repay government funds. GDP may grow again. But a person who lost a house does not simply recover because an index rises. A worker who spent years unemployed or underemployed carries that loss forward. A graduate who entered the labor market during the recession may experience lower earnings for years. A family that depleted savings may never fully rebuild them. Trust, once lost, does not return automatically. The Lehman file therefore extends beyond September 2008. It extends into the long aftermath of diminished confidence. It extends into politics. It extends into regulatory architecture. It extends into the way people speak about Wall Street. It extends into the caution many households carry around debt. It extends into the suspicion that the people designing financial products may not bear the full cost when those products fail. That suspicion is not baseless. It is part of the social cost of the crisis. The crisis also changed careers inside finance. Risk management became more visible. Compliance grew, capital and liquidity rules became central to strategy. Trading businesses changed, compensation practices faced scrutiny. The era of standalone investment banks effectively ended. Bear Stearns disappeared into J.P. Morgan. Merrill Lynch went to Bank of America. Lehman failed. Goldman Sachs and Morgan Stanley became bank holding companies, placing them under Federal Reserve supervision. The old Wall Street model had been transformed. This was one of the structural consequences of Lehman. The independent investment bank, highly leveraged and dependent on market funding, no longer seemed safe in the same way. The model had worked in a long expansion. It failed under stress. This change marked the end of an era that had begun after earlier regulatory and market shifts. Wall Street did not disappear. It adapted, but the landscape after 2008 was different. The firms that remained were larger, more regulated, and more closely tied to the banking system. The crisis also changed the public vocabulary. Before 2008, terms like subprime, mortgage-backed securities, collateralized debt obligations, credit default swaps, and too big to fail were not part of everyday conversation. After the crisis, they entered common speech, often as symbols rather than precise concepts. People did not need to understand every tranche to understand that something had gone wrong. The language of finance became the language of betrayal. AAA no longer sounded purely safe. Innovation no longer sounded purely positive. Leverage no longer sounded merely technical. Bailout became one of the defining words of the period. The meaning of these words changed because lived experience changed them. Language carries memory. After Lehman, the word risk sounded different. The firm's internal culture has been studied and debated because culture shapes how information moves. In a healthy risk culture, bad news travels upward. In an unhealthy one, bad news is softened, delayed, or reframed. Lehman had talented risk professionals. It had reports. It had committees. It had models. But formal systems do not guarantee effective challenge. The question is whether challenge changes decisions. If risk management is treated as a box to check, it will not save a firm. If risk managers lack authority, warnings become documentation rather than action. If leadership wants growth, risk concerns may be negotiated down. If compensation rewards revenue more than resilience, the culture will learn the lesson. This is not unique to Lehman. It is one of the central governance problems in finance. Risk is often most visible to the people with least power to stop it. The people with power may have the most reason not to stop it. That imbalance must be corrected by strong institutions. When it is not, the system relies on luck. Luck held for a while, then it did not. The housing market's national decline was the event many models had treated as unlikely, but unlikely is not impossible. Financial institutions sometimes confuse low probability with no probability. They build positions that survive ordinary stress, then extraordinary stress arrives. The word extraordinary can be misleading because each crisis is extraordinary until it happens. After it happens, it becomes historical data. Models are updated, rules are revised. People say they will not make the same mistake again. They usually do not make exactly the same mistake. They make a related one in a new form. This is why the Lehman file remains useful. Not because the next crisis will be mortgage-backed securities in the same structure. It may not. But because the patterns repeat. Leverage, short-term funding, opacity, crowded assumptions, ratings or models treated as certainty, compensation tied to short-term gains, regulation behind innovation, confidence mistaken for safety. Those patterns can appear in many markets. The instruments change, the habits remain. The final assessment of Lehman should avoid simplicity. The firm was not merely unlucky. It took risks. It maintained high leverage. It had large real estate exposures. It struggled to restore confidence. It used accounting practices that later drew severe criticism. Its leadership did not secure a rescue or capital solution in time. At the same time, Lehman was not alone in building the crisis. The entire system had moved in the same direction. Other institutions were rescued. Government policy was inconsistent because the crisis itself was evolving. Market panic magnified losses. The legal tools available to policymakers were debated and limited. The collapse was both firm-specific and systemic. That is why it remains difficult. If it were only firm-specific, the lesson would be easy. Avoid Lehman's mistakes. If it were only systemic, the lesson would be easy in a different way. Blame the system and move on. But it was both. The firm made choices inside a system that made those choices profitable until they became fatal. The system allowed those choices to accumulate until one firm's failure threatened everyone. That dual responsibility is uncomfortable. It gives no one complete innocence. It gives no one complete explanatory power. The sleep version of the story should hold that discomfort gently, not as accusations shouted into the dark, as a file read carefully. Here is the firm. Here is the market. Here is the mortgage. Here is the rating. Here is the leverage. Here is the weekend. Here is the filing. Here is the family losing a home 2 counties away. Here is the retiree watching a balance shrink. Here is the policymaker choosing between 2 bad outcomes. Here is the employee carrying a box. Here is the old name on the door suddenly belonging to history. The Alabama beginning is easy to pass over too quickly. A dry goods store can seem too small compared with a $600 billion bankruptcy. But the beginning matters because it reminds us that finance often grows from ordinary exchange. Henry Lehman did not arrive in America to build a global investment bank. He arrived as an immigrant seeking opportunity. He opened a store. He served customers. He accepted what the local economy gave him. In Montgomery, that meant cotton. Cotton was not merely a crop. It was a system of wealth, labor, land, credit, and trade. It was also inseparable from slavery and the brutal economy of the antebellum South. Any honest account of cotton finance must acknowledge that world. The early Lehman business developed inside it. The brothers' movement into cotton trading connected them to one of the central commodities of 19th century America. From there, the firm moved toward New York because New York was where capital gathered. This movement from local goods to national finance mirrors the country's own movement. America grew, markets deepened, capital became more organized. The firm followed the flows. By the late 19th and early 20th centuries, finance was becoming more professional, more national, and more powerful. Railroads needed money, industrial companies needed money, merchants needed credit, investors wanted opportunities. Firms like Lehman helped connect these needs. There is an important difference between condemning finance and understanding it. Finance is not merely speculation. It can build. It can connect savings to enterprise. It can help companies expand. It can help households buy homes. It can help governments fund projects. The problem is not that finance exists. The problem is that finance can become detached from the real things it is meant to serve. When that detachment grows too wide, financial claims multiply faster than the underlying capacity to honor them. In 2008, the underlying real thing was the American home. The claims built on top of it had become too large, too complex, and too fragile. Lehman's long survival through earlier crises also deserves more than a list. The Civil War disrupted the Southern economy that had shaped the firm's beginnings. The Great Depression devastated banks and markets. The post-war period transformed American finance. The late 20th century brought deregulation, globalization, computing power, and increasingly complex securities. Each era demanded adaptation. Lehman adapted. That adaptability became part of the firm's self-understanding. It is not hard to imagine why. Institutions tell stories about themselves because stories help people act under pressure. Lehman's story was resilience. It had been doubted, it had survived, it had been pushed aside, it had returned. This story can produce extraordinary commitment. Employees believe they belong to something with a fighting spirit. Leaders believe the firm has a special capacity to endure. But resilient stories can make structural vulnerability harder to see. If every past crisis ended with survival, the next crisis may be interpreted through the same lens. Hold on. Fight back. Do not let outsiders define the firm. Wait for the market to recognize value. Those instincts can be useful. They can also be fatal. The 1994 spin-out from American Express was a key modern moment. Lehman became independent again after years inside a larger corporate structure. The firm had to prove itself. Fuld, who became chief executive, led it through that period. Under his leadership, Lehman grew in stature and profitability. The firm developed a reputation for scrappiness and focus. It was not always seen as the most polished Wall Street house, but it was competitive. It wanted respect. This desire for respect can shape risk appetite. A firm trying to climb league tables may push harder. It may enter businesses aggressively. It may be less willing to shrink when competitors are still earning. It may interpret caution as retreat from the status it fought to win. By the 2000s, Lehman had won status. It was powerful. It was profitable. It was admired in many circles. But the hunger that helped build it had not disappeared. Hunger is useful until the meal becomes dangerous. The mortgage business fed that hunger. The fees were attractive. The demand was strong. The products were central to the era. Lehman could compete in origination, securitization, trading, and investment. The business touched many parts of the firm. This made mortgage exposure not merely a position, but an ecosystem. When a risk is embedded across an institution, reducing it becomes politically and operationally difficult. One desk's asset is another desk's pipeline. One group's revenue is another group's risk. One executive's success is tied to a market another executive fears. The firm becomes internally invested in the continuation of the boom. This is another reason warnings can fail. They do not confront an empty room. They confront a room full of people whose plans depend on the warning being wrong. The 2008 timeline should be heard slowly. In March, Bear Stearns fell into J.P. Morgan's arms with government support. The market looked at Lehman next. In June, Lehman reported a quarterly loss and raised capital. Confidence weakened but did not vanish. In summer, possible strategic deals were explored. Investors watched Korea Development Bank discussions with hope. In early September, that hope faded. The stock fell sharply. On September 10, Lehman announced the large loss and restructuring plan. The plan did not restore trust. On September 12, major Wall Street leaders were summoned to discussions at the New York Fed. The weekend began. Inside that weekend, time behaved differently. In a normal acquisition, buyers study carefully. They examine assets, they negotiate warranties, they seek approvals, they plan integration, they protect themselves. There was no normal time. Potential buyers had to evaluate an enormous, complex institution in a market panic. They needed to know what losses they might inherit. They needed regulatory clarity. They needed financing. They needed confidence that buying Lehman would not endanger themselves. The government wanted a deal without public money. That desire was understandable, but it made the deal harder. If the government would not absorb or guarantee the worst assets, a buyer had to. Why would a buyer accept unknown losses in a collapsing market? The weekend therefore revolved around the same question in different forms. Who takes the bad assets? Who takes the uncertainty? Who takes the political risk? Who takes the blame? No answer held. By Sunday, the possibility of a Barclays deal had weakened because British approval could not be obtained in time. Bank of America had chosen Merrill Lynch. The consortium idea did not solve the problem. Lehman was left without a path. The bankruptcy filing became unavoidable. When the filing came, it created a rupture partly because financial markets depend on weekend repairs. Crises often intensify on Fridays and are resolved before Monday. The public may not see how often emergency work happens in the dark. A weak bank is sold, a guarantee is arranged, a central bank facility is announced, a statement is prepared. Markets opened with a solution already in place. That weekend, the solution did not arrive. Monday opened on to failure. This is why September 15 has such power. It was the morning when the system showed an empty hand. The shock was psychological as much as financial. If Lehman could fail, what else could fail? If money market funds could break the buck, what else was unsafe? If mortgage ratings had been wrong, what else had been misrated? If counterparties could be trapped in a bankruptcy estate, whom could anyone trust? The questions multiplied faster than answers. Markets can survive bad news. They struggle with unbounded uncertainty. Lehman created unbounded uncertainty because no one knew the full map of exposure. The map had to be discovered during the panic. That is always too late. The broader economy felt the panic through tightening credit. Credit is often invisible when it works. A business rolls over a loan. A consumer uses a credit line. A car buyer receives financing. A student loan is funded. A retailer stocks inventory. A manufacturer pays suppliers before customers pay invoices. These ordinary activities depend on trust in repayment and functioning capital markets. When trust weakens, credit becomes scarce. Scarce credit slows spending. Slower spending reduces revenue. Reduced revenue leads to cuts. Cuts lead to unemployment. Unemployment leads to defaults. Defaults weaken lenders. Again, the loop closes. The crisis began in finance but became macroeconomic through these loops. Families did not need to know the word securitization to suffer from it. Many people experienced the recession as a private failure. They lost jobs and wondered what they had done wrong. They lost homes and felt shame. They cut expenses. They delayed retirement. They moved in with relatives. They postponed education, children, businesses, repairs, medical care, and ordinary hopes. But the failure was not only private, it was systemic. Millions of people were hit by a machine they had not built. This is the moral weight of Lehman. The decisions were technical. The suffering was personal. The crisis also changed how young people saw institutions. Someone entering adulthood in 2008 saw banks fail, jobs disappear, homes foreclose, and governments rescue institutions that seemed responsible for the disaster. That experience shaped attitudes toward debt, home ownership, employment, and authority. It is not an accident that the crisis echoed through later politics. Economic shocks become cultural memory. They change what people believe is possible. They change what people distrust. They change the stories parents tell children about security. The Lehman bankruptcy was one event inside that larger memory, but it became a marker. Before Lehman, after Lehman. Those phrases meant something. They marked the end of an illusion that sophisticated finance had made the system safer by distributing risk. It had distributed risk. But distribution without understanding can become contagion. Risk spread so widely that no one knew where it would erupt. That is not safety. That is fog. The crisis literature often focuses on models, incentives, and regulation. Those are essential. But there was also a spiritual failure of humility. Not spiritual in a religious sense, spiritual in the sense of posture toward uncertainty. The system became too confident in its ability to measure what it had created. It believed that past housing data could describe future housing stress. It believed that tranching could make weak loans safe enough. It believed that liquidity would remain available. It believed that large institutions could manage complexity. It believed that risk had been dispersed intelligently. It believed that innovation had outrun older dangers. The older dangers had not disappeared. Debt, leverage, panic, overconfidence, herd behavior. They had only changed clothes. Lehman wore the new clothes of old dangers. That is why the story belongs beside older collapses. The instruments were modern. The pattern was ancient. People borrowed against rising assets. They believed the rise would continue. They built obligations on that belief. They used complexity to reassure themselves. Then prices fell. The obligations remained. The confidence left. The structure broke. The names change across history. The rhythm repeats. Lehman also shows how a single institution can become a teaching object larger than itself. Students study it in business schools. Regulators study it in policy discussions. Risk managers study it as a warning. Journalists return to it when markets tremble. Politicians invoke it in debates over bailouts. Investors use it as shorthand for sudden, systemic danger. The firm became more useful as a lesson than it had been as a company. That is a strange afterlife. A living firm wants profit. A dead firm provides instruction. Lehman's instruction is severe. Do not mistake liquidity for permanence. Do not mistake ratings for truth. Do not mistake complexity for safety. Do not mistake survival for immunity. Do not mistake confidence for capital. Do not mistake a rising market for intelligence. These lessons sound simple after the fact. They are difficult before the fact because the boom rewards forgetting them. In a boom, caution looks expensive. In a bust, caution looks obvious. The distance between those two perceptions is where losses accumulate. The long aftermath of Lehman unfolded in layers. The first layer was panic. That was immediate. Markets fell, credit froze, officials improvised, financial news became a public anxiety feed. People who had never watched banking policy began hearing names like AIG, TARP, Fannie Mae, Freddie Mac, and the Federal Reserve in daily conversation. The second layer was recession. That was slower. Companies cut jobs. Households reduced spending. State and local governments faced budget pressure. Construction slowed. Retail weakened. Manufacturing contracted. The crisis moved from balance sheets into payrolls. The third layer was memory. That lasted longest. People remembered the phone call about a layoff. They remembered the foreclosure notice. They remembered watching retirement savings fall. They remembered graduating into a labor market that seemed closed. They remembered parents selling homes for less than expected. They remembered businesses that never reopened. They remembered the feeling that the adults in charge did not fully understand the system they had built. Memory is one of the least measured consequences of financial crisis. It does not appear cleanly in GDP. It does not show up as a capital ratio, but it changes behavior. People become more cautious, or more angry, or more distrustful. They borrow differently. They vote differently. They teach their children differently. They hear promises differently. After Lehman, many people heard financial confidence as a warning rather than reassurance. The crisis also changed how people viewed home ownership. For generations, owning a home had been presented as one of the safest paths to stability. The crisis did not erase that idea, but it complicated it. People learned that a home could fall in value. They learned that mortgage terms mattered. They learned that refinancing might not be available when needed. They learned that neighborhoods could be damaged by waves of foreclosure. They learned that personal responsibility, while important, could not fully protect a household from systemic failure. This was a painful lesson because home is intimate. A stock portfolio can feel distant. A home is where children sleep. It is where families gather. It is where ordinary routines take place. When the housing market collapses, the damage enters private rooms. The Lehman file therefore contains many houses, not only one bank. Some were bought with loans that should never have been made. Some belonged to people who did everything responsibly and were still hurt by falling prices or job loss. Some stood empty after foreclosure. Some became investor properties. Some neighborhoods recovered. Others carried vacant lots and damaged credit histories for years. The crisis was uneven. That unevenness mattered. Financial collapses do not distribute pain with moral precision. The most reckless person is not always the one who suffers most. The most careful person is not always spared. Risk travels through systems and lands where it can. This is why systemic risk is morally unsettling. It breaks the simple connection between individual choice and individual consequence. Lehman also changed the relationship between Wall Street and Washington. The two had always been connected. Finance depends on law, regulation, central banking, and government debt. Government depends on functioning credit markets. But after 2008, the connection became more visible and more resented. When markets were rising, financial institutions often celebrated the efficiency of private markets. When crisis arrived, many needed public support. The public noticed the asymmetry. Profits had been private. Losses became social. This phrase is sometimes used too easily, but in the crisis it captured a real feeling. The state stepped in because the alternative was worse. But the necessity of intervention did not erase the unfairness people felt. The political system struggled to explain that distinction. Yes, rescues may be necessary. Yes, rescues may still be unfair. Yes, allowing collapse may be principled. Yes, allowing collapse may still harm innocent people. The public wanted clarity. The crisis offered trade-offs. Trade-offs are hard to turn into trust. The Dodd-Frank Act tried to address some of the structural weaknesses. It increased oversight of large financial institutions. It created mechanisms for resolving failing firms outside ordinary bankruptcy when systemic risk was involved. It imposed new rules on derivatives. It created the Consumer Financial Protection Bureau to focus on consumer financial products. It required stress testing and living wills. The purpose was not to make crisis impossible. No law can do that. The purpose was to make the system more resilient and reduce the chance that a single large failure would trigger panic on the scale seen after Lehman. Stress tests became a ritualized form of institutional imagination. Regulators asked banks to model severe scenarios. What happens if unemployment rises? What happens if asset prices fall? What happens if markets freeze? Do you have enough capital? Do you have enough liquidity? Can you keep lending? These questions are attempts to force memory into the present. They say, remember Lehman. Remember what happens when confidence disappears. Remember that stress is not theoretical. Living wills served a related purpose. Large financial institutions had to describe how they could be resolved in an orderly way if they failed. This was a direct response to the chaos of firms like Lehman. If a giant institution fails, regulators need a map. Where are the subsidiaries? Where are the critical operations? Which entities hold assets? Which contracts matter? How can the firm be unwound without destroying the system around it? Before the crisis, too little attention had been paid to failure planning. Success had been mapped, failure had not. Lehman showed that failure planning is not pessimism, it is infrastructure. Derivatives reform also came from the crisis. Credit default swaps had allowed institutions to take or hedge credit exposure in ways that were not always transparent. AIG's rescue made the danger visible. Derivatives could connect firms in hidden ways. If one major seller of protection could not perform, the consequences could spread quickly. Central clearing and reporting requirements were intended to make the market safer and more visible. Again, reform did not eliminate risk. It tried to move risk into structures that could be monitored. The Consumer Financial Protection Bureau reflected another lesson. The mortgage crisis had not only been a wholesale financial problem, it had involved consumer products that many borrowers did not fully understand. Loan terms, disclosures, broker incentives, servicing practices, and foreclosure processes all mattered. Consumer finance could no longer be treated as separate from systemic risk. Bad loans made to households could become securities. Securities could become bank assets. Bank assets could become systemic danger. The chain began at the kitchen table. Regulating only the top of the chain was not enough. Still, reforms did not satisfy everyone. Some argued they were too burdensome and restricted credit. Others argued they did not go far enough. Some wanted large banks broken up. Some wanted stricter limits on leverage. Some wanted criminal accountability for senior executives. Some wanted homeowners helped more directly. The debate continued because the crisis had damaged trust in judgment itself. When trust is broken, every reform looks insufficient to someone. The Lehman bankruptcy estate, meanwhile, continued its quiet work. It recovered assets, it paid creditors, it resolved claims, it litigated disputes. Years passed. The public story moved on. Other crises arrived. Other markets rose. Other headlines filled the screens. But the estate continued. This slow administrative life of a dead bank is almost ghostly. The trading floors no longer shout. The executives no longer lead the firm. The stock no longer trades as it once did. But the legal entity persists in fragments, returning money where it can, arguing where it must, closing doors one by one. Financial death is rarely instantaneous. It has paperwork. The sale to Barclays preserved a portion of Lehman's American operations. For Barclays, the transaction became an opportunity to expand its investment banking presence in the United States. For former Lehman employees who moved into Barclays, it offered continuity after shock. But continuity under a new name is not the same as survival. The Lehman culture was broken. Pieces were absorbed. The institution was not. Nomura's acquisition of Lehman operations in parts of Asia and Europe played a similar role. Businesses and people moved. The name did not carry them in the old way. This is how institutions die in modern finance. not always by disappearing physically, by being divided, by being renamed, by having their people absorbed into other systems, by leaving behind legal claims and historical lessons instead of a living culture. For the employees who remained in finance, the crisis changed the atmosphere of work. Risk departments gained status. Compliance expanded. Regulators were more present. Capital was watched more closely. Liquidity became a board-level concern in a new way. Compensation faced scrutiny. The language of resilience entered strategy. Some of this may have felt restrictive to people who remembered the pre-crisis boom. But restriction was part of the point. A system that had nearly failed could not simply return to the same posture. The crisis also reshaped academic and professional thinking. Economists studied financial frictions, shadow banking, fire sales, and systemic risk with renewed urgency. Business schools taught Lehman as a case in leverage, liquidity, governance, and crisis management. Central bankers studied emergency tools. Lawyers studied resolution regimes. Accountants studied disclosure and off-balance sheet presentation. Risk managers studied stress scenarios. The file became a curriculum. This is one way societies process disaster. They turn pain into teaching. The teaching is never enough to undo the pain, but it can reduce the chance of repetition. Sometimes. The comparison between Lehman and other collapses is instructive. Enron was a story of accounting complexity, off-balance sheet entities, and corporate deception around an energy trading myth. Theranos was a story of a medical promise that technology could not fulfill. WeWork was a story of a real product inflated by capital, charisma, and valuation. Lehman was different. It was not one company's product failure. It was not a single fraudulent machine. It was a financial institution overexposed to a system-wide mispricing of housing risk and dependent on confidence that could vanish quickly. Its collapse mattered because it was a gateway. Through Lehman, the housing crisis became unmistakably a financial system crisis. The story is therefore less intimate in one sense and more far-reaching in another. There is no single lab device, no single office brand, no single energy trading structure. There is a system of claims built on homes and confidence. That makes the narration harder and more important. The listener must understand the machine without being buried by it. The machine can be stated plainly. Loans were made, loans were sold, loans were pooled, pools were sliced, slices were rated, rated slices were bought, bought slices were financed, financed positions were leveraged, leveraged firms needed funding, funding required confidence, confidence depended on asset values depended on housing, housing fell, confidence left, the machine reversed. That reversal is the spine of the crisis. Everything else is detail, consequence, and human cost. The quiet tragedy is that many participants could see only their segment of the machine. The borrower saw a mortgage, the broker saw a loan, the originator saw volume, the securitizer saw product, the rating agency saw a model, the investor saw yield, the trader saw price, the executive saw revenue, the regulator saw pieces of a large market. Few saw the whole machine clearly enough, early enough, with enough authority to slow it. This is how systemic risk hides, not by being invisible, by being visible in pieces. The pieces look manageable, the whole is not. Lehman became the moment when the whole appeared. By then it was too late for the firm. The final lull should return to the morning, September 15, 2008. The city was ordinary before the news. That ordinariness matters. Disasters often arrive into ordinary mornings. The coffee is still hot. The train is still crowded. The elevator still opens. The calendar still shows meetings. The body continues its routine for a few minutes after history has already changed. Employees entered Lehman offices with that ordinary expectation. Some may have known the weekend had been dire. Some may have feared the worst. Some may have hoped a deal would appear. The institution had survived before. Perhaps it would survive again. Then the filing made hope irrelevant. The firm was in bankruptcy. The name was no longer a guarantee of continuity. The morning became historical. Outside the building, reporters gathered. Inside, people tried to understand what came next. In markets, traders tried to understand exposures. In Washington, officials tried to contain the spreading panic. In homes far from New York, people did not yet know how the day would reach them. But it would. It would reach through credit, through employment, through housing, through retirement accounts, through public budgets, through politics, through memory. This is why the file cannot close only on Wall Street. It must close with the wider system. The mortgage payment mailed from a kitchen table, the security built from thousands of such payments, the rating stamped onto the security, the repo loan made against it, the investment bank leveraged around it, the counterparty exposed to the bank, the money market fund holding the debt, the company needing commercial paper, the worker needing a paycheck, the family needing the paycheck to pay the mortgage. The circle is not poetic, it is financial. And when the circle broke, it broke in ordinary places. The old Lehman name now rests in history. It belongs to case studies, documentaries, policy papers, bankruptcy records, and the memories of people who watched the crisis unfold. It is no longer a living Wall Street power. But the lesson remains active. Risk that is spread through a system has not disappeared. Risk that is modeled has not been mastered. Risk that is profitable has not become safe. Risk that is hidden by rising prices will return when prices fall. The file is heavy because the lesson was expensive. It was paid by shareholders, by employees, by creditors, by taxpayers, by homeowners, by workers, by students entering a damaged economy, by communities that took years to recover. The cost was not contained in the bankruptcy petition. No petition could hold it. So now the file closes slowly. The trading floor is quiet. The phones no longer ring with Lehman's name. The screens have moved on to other symbols. The old building holds other workers. The markets have reopened many times since. New risks have been priced. New confidence has formed. New assumptions have gathered. That is what markets do. They continue. Continuation is not innocence. It is simply motion. The task is to remember while motion resumes, to remember the cotton store and the global balance sheet, to remember the mortgage and the security, to remember the rating and the model, to remember the weekend and the empty solution, to remember the employee with the box, to remember the family far away that did not know why the economy had shifted beneath them. The file returns to the archive. Its label is plain: Lehman Brothers. 158 years, from cotton to bankruptcy, from trust to panic, from a name that survived almost everything to a name that could not survive the thing it helped build. The room is quiet now. The markets are closed. The lesson has been filed. There is still another way to read the Lehman file. It is as a story about distance, distance between borrower and lender, distance between lender and investor, distance between risk and responsibility, distance between price and value, distance between confidence and truth. At the beginning of a traditional loan, the distance is short. A banker knows the borrower. The borrower knows the banker. The loan remains nearby. If it fails, the loss is also nearby. Modern finance lengthened that distance. The borrower might never know who ultimately owned the risk. The investor might never see the house. The trader might never meet the family. The rating model might never feel the neighborhood decline. The executive might see only aggregated exposure, not the human stories inside the pool. Distance can create efficiency. It allows capital from one part of the world to fund homes in another. It allows risk to be shared. It allows markets to scale. But distance also weakens accountability. When the loan is bad, who feels responsible? The broker who originated it, the lender who approved it, the bank that bought it, the structurer who pooled it, the rating agency that rated it, the investor who purchased it, the regulator who allowed the system, the borrower who signed. The answer can be many people and no one. That is the danger. Responsibility spread too thinly can become responsibility lost. Lehman's collapse forced responsibility back into view, but only after the losses had traveled. The same distance existed inside the firm. Senior leaders saw summaries, desks saw positions, risk teams saw reports, traders saw markets, accountants saw treatments, treasury teams saw funding needs. Each group understood something. The institution needed to understand the whole. Large organizations struggle with wholeness. Information moves upward in compressed form. Bad news is interpreted. Numbers are debated. Judgment is filtered through hierarchy, culture, and incentive. By the time a risk reaches the top, it may no longer feel urgent enough, or it may arrive urgently but too late. This is why governance is not only about committees and titles, it is about whether truth can travel. Truth must travel faster than risk. At Lehman, risk traveled faster. The firm also demonstrates the danger of funding illiquid assets with fragile money. An illiquid asset is not necessarily bad. A building is illiquid. A private loan is illiquid. A complex security can be illiquid. These assets can have value, but if a firm finances them with short-term borrowing, it must be prepared for lenders to withdraw. The asset may be valuable in the long run and still deadly in the short run. Time becomes the enemy. If the firm has to sell quickly, it may receive a distressed price. If it cannot sell, it may fail to meet obligations. This is the old banking problem in modern clothes: long assets, short funding, confidence in between. Commercial banks have deposit insurance and central bank access because society learned long ago that runs are destructive. Investment banks operated with different structures. They were vulnerable to market runs. Lehman was not run by retail depositors outside branches. It was run by institutions stepping back. The effect was similar. Funding left, liquidity vanished, assets could not be sold at values that preserved confidence. The bank failed, the language was modern, the pattern was old. Another quiet feature of Lehman's collapse was speed. For years, risk accumulated slowly. Then the end came quickly. This rhythm appears often in finance: slow build, sudden break. The slow build creates complacency. Each day the system survives becomes evidence that it can keep surviving. Each successful rollover of funding suggests funding will remain. Each quarter of profits confirms strategy. Each warning that does not immediately produce collapse makes the next warning easier to dismiss. Then a threshold is crossed. A buyer walks away. A rating agency threatens action. A lender refuses terms. A rumor hardens. A market opens lower. The firm discovers that time has changed. Yesterday it could wait. Today it cannot. This change in time is one of the most frightening parts of crisis management. Executives who are used to planning in quarters must think in hours. Lawyers draft documents through the night. Regulators make decisions with incomplete information. Potential buyers demand protection. Traders watch prices that no longer behave. The institution becomes a clock. Every hour matters. For Lehman, the clock ran out before a transaction could be built. The bankruptcy filing was the sound of the clock stopping. The crisis also revealed how market discipline can arrive too late. In theory, markets discipline firms by pricing risk. If a firm takes too much risk, investors demand higher returns or withdraw funding. That pressure should force correction. In practice, markets may underprice risk for years and then reprice it violently. Too little discipline during the boom. Too much discipline during the panic. This pattern makes market discipline unreliable as the only safeguard. During the boom, everyone earns. During the panic, everyone runs. Neither phase is calm enough to produce perfect judgment. Regulation exists partly because markets do not always discipline gradually. They can sleep and then stampede. Lehman was caught in the stampede, but it had also benefited from the sleep. The years before the crisis allowed leverage and mortgage exposure to grow under favorable conditions. The market did not stop it early. When the market finally stopped it, the stop was fatal. The story of Lehman is also a story about marks. Marking assets to market sounds straightforward. An asset is worth what the market says it is worth. But when markets are illiquid or distressed, valuation becomes contested. If a security rarely trades, what is its fair value? If the only buyers are distressed, should that price define the asset? If management believes cash flows will recover, should it mark lower now? If investors distrust management, will they accept the mark? In a crisis, valuation becomes a battlefield. Optimistic marks preserve capital and confidence for a time. Pessimistic marks may accelerate losses, but marks that appear too optimistic destroy trust. Lehman faced exactly this problem. The market wanted confidence that the firm's assets were valued realistically. Management wanted to avoid marks that would deepen the crisis. Potential buyers wanted protection against the marks being wrong. The disagreement itself became dangerous. When no one trusts the numbers, even accurate numbers struggle to persuade. Trust, once weakened, does not respond instantly to explanation. It asks for capital. It asks for guarantees. It asks for time. Lehman did not have enough of any. The personal arc of Richard Fuld also belongs in the file, but it should be handled carefully. It is easy to turn a crisis into a portrait of one man. That would be too simple. Fuld did not create the global housing bubble alone. He did not design every mortgage product. He did not control every rating model, regulator, investor, or counterparty, but he led Lehman. He shaped its culture. He made decisions and set tone. He represented the firm to the market. Leaders matter most when institutions face reality they do not want to accept. They decide whether to preserve image or absorb pain. They decide whether to raise capital early or wait. They decide whether to sell assets at unattractive prices or hope for recovery. They decide whether dissent is welcomed or punished. They decide whether survival means fighting harder or changing faster. Fuld's defenders might say he fought for the firm until the end. His critics might say he fought reality too long. Both readings can sit in the same file. The tragedy is that loyalty to an institution can become dangerous when the institution needs a colder assessment than loyalty allows. The weekend negotiations were full of people facing their own constraints. Treasury officials had political constraints. Federal Reserve officials had legal and systemic constraints. Potential buyers had shareholder and regulatory constraints. Other Wall Street firms had competitive and financial constraints. British regulators had their own duties. Lehman had no bargaining power left. This is another lesson. A firm should seek rescue before rescue is the only option. When rescue is optional, terms can be negotiated. When rescue is necessary, terms become survival. Lehman reached the weekend with too few options. At that point, even people who wanted to avoid bankruptcy could not assemble the pieces. The failure was therefore not only that no one saved Lehman, it was that Lehman entered the final weekend needing too much saving. The burden was too large. The time was too short. The politics were too hostile. The assets were too uncertain. The confidence was too damaged. The door closed. After the door closed, the world did what it always does after financial shock. It searched for narratives. Some said Lehman was sacrificed to teach markets a lesson. Some said it was impossible to save. Some said officials underestimated the consequences. Some said the firm deserved its fate. Some said the system deserved the blame. Narratives help people bear complexity, but the file resists one narrative. It contains several truths. Lehman took excessive risk. The system encouraged excessive risk. The government was inconsistent. The tools were limited. The market panicked. The panic revealed real weakness. The collapse caused harm beyond those responsible. The rescue of others created anger. The non-rescue of Lehman created panic. These truths do not cancel one another. They make the story hard. And because the story is hard, it is worth telling slowly. The quietest victims of the crisis were often those with the least vocabulary for it. A child whose family moved after foreclosure, a worker whose factory reduced shifts, a local shop owner whose customers stopped spending, a retiree who delayed retirement, a graduate who accepted work far below their training, a family that stopped opening mail because every envelope felt dangerous. These people may never have heard of Repo 105. They may never have read a Lehman earnings report. They may not know what a credit default swap is, yet the crisis reached them. This is why financial systems carry moral responsibility. Their complexity does not make them less human. It makes the human consequences harder to trace. When tracing is hard, accountability becomes weaker. The file must do some of that tracing, from the mortgage to the security, from the security to the balance sheet, from the balance sheet to the bankruptcy, from the bankruptcy to the panic, from the panic to the recession, from the recession to the household. That chain is long, but it is the chain people lived. The post-crisis recovery also deserves a careful tone. The economy did recover. Markets stabilized. Banks rebuilt capital. Unemployment eventually fell. Housing markets recovered in many places. Some investments made during the rescue period were repaid. The financial system did not end, but recovery does not erase the path. A forest can regrow after fire. The fire still happened. Some trees do not return. Some soil changes. Some people move away. Economic recovery works like that. The aggregate line rises. Individual losses remain scattered underneath it. Lehman belongs to those scattered losses as much as to the market charts. The firm's name became an archive label for the moment the crisis became undeniable. It is possible that if Lehman had been saved, another name would have become the symbol. Perhaps AIG, perhaps a bank, perhaps a money market fund. The pressure in the system was enormous. Something was likely to break. But Lehman was the break that occurred. History often works this way. Structures create pressure. Individuals and institutions become the place where pressure becomes visible. Lehman was a cause and a symptom. It helped create the conditions of its fall. It also revealed conditions larger than itself. That dual role is why the file remains heavy. The final hours before bankruptcy were not only technical, they were human hours. People were tired, they were afraid, they were negotiating under pressure, they were calculating losses that could not be known with certainty. They were considering public money in a climate of public anger. They were protecting their own institutions. They were trying to imagine Monday. Monday is an important word in finance. Markets open on Monday. Payrolls continue on Monday. Headlines move on Monday. If a solution is not ready by Monday, theory becomes event. For Lehman, Monday came without a solution. That is why the morning remains fixed in memory. The weekend had failed to contain the future. The future opened anyway, and it opened badly. Now, years later, the story can be told without the heat of the screens. The numbers can be placed in order. The mortgage machine can be explained. The incentives can be traced. The leadership choices can be weighed. The policy dilemmas can be held without pretending they were easy. The human consequences can be returned to the center. This is what a file does when it is read properly. It does not only accuse, it preserves sequence. It allows the listener to hear the slow approach of a collapse that once felt sudden. The approach began with confidence. Confidence in housing, confidence in ratings, confidence in liquidity, confidence in models, confidence in old names, confidence in rescue, confidence in the ability of sophisticated people to manage what they had built. Each confidence had some basis. That is why it was persuasive. Each confidence also had a limit. That is why it failed. The file closes, but the pattern remains available for future markets. When assets rise for a long time, ask what belief is being built into the rise. When leverage grows, ask who provides the funding. When funding is short-term, ask what happens if it does not roll. When products become complex, ask who truly understands them. When ratings are treated as truth, ask what assumptions sit beneath them. When executives say the market misunderstands them, ask whether the market may be seeing something real. When a firm says it has survived everything, ask whether this risk is different from the last one. These questions are quiet. They do not stop a boom by themselves, but they are the beginning of vigilance. Vigilance is not fear. It is respect for the fact that financial systems are powerful because they are connected and dangerous for the same reason. Lehman forgot, or ignored, or underestimated that respect. The system around it did too. The cost was severe. The cost is why the name still matters. Lehman Brothers, not merely a failed bank, a reminder that the safest-looking structures can depend on assumptions no one has tested under sufficient stress, a reminder that old names can carry new risks, a reminder that in finance the line between ordinary mourning and historic collapse can be thinner than it appears. One final reflection belongs to the people who trusted the word safe. Safe is one of the most powerful words in finance. It is also one of the most dangerous. A safe asset, safe rating, a safe institution, a safe market, a safe assumption. The word can calm people. It can lower vigilance. It can allow money to move without fear. Modern economies need some belief in safety. Without it, credit would stop, investment would freeze, households would hoard, businesses would shrink, but safety must be earned continuously. It cannot be inherited from a name. It cannot be printed by a rating. It cannot be assumed from recent history. It cannot be created by complexity. Lehman had an old name. Mortgage securities had ratings. Housing had history. The models had confidence. The markets had liquidity. Each seemed to carry some version of safety. None was enough. The collapse teaches that safety in finance is not a single object. It is a relationship among assets, funding, capital, transparency, incentives, and trust. If one part weakens, the system may hold. If many weaken together, the word safe can disappear quickly. Lehman lost safety in layers. First, the housing assumption weakened, then mortgage securities weakened, then confidence in marks weakened, then confidence in capital weakened, then confidence in funding weakened, then confidence in rescue weakened. By the time the filing arrived, safety was gone. The morning only made the disappearance official. This layering matters because it helps us understand why people did not react sooner with enough force. At each stage, the problem could be framed as limited. Subprime is limited. Housing weakness is regional. Structured products are protected. Losses are manageable. Funding is available. Capital can be raised. A buyer can be found. A weekend can solve it. Each sentence bought time. Each sentence made the final sentence harder. Bankruptcy. The file also asks what courage looks like in finance. It is not only the courage to take risk. That kind of courage is often celebrated. The trader who makes the bold call, the executive who expands when others hesitate, the investor who buys when others doubt. But there is another kind of courage, the courage to reduce risk when profits are strong, the courage to mark assets down before the market forces the issue, the courage to raise capital before it is humiliating, the courage to tell shareholders that growth must slow, the courage to challenge a profitable desk, the courage to admit that the model is less certain than it appears, the courage to leave money on the table because the table may not be stable. That courage is quieter. It rarely receives applause during a boom, but it is the courage that prevents files like this from becoming necessary. Lehman did not show enough of that quieter courage, nor did much of the system around it. The boom rewarded a louder courage. The bust punished the absence of the quiet one. There is also a lesson about scale. A small mistake can remain local. A large mistake inside a connected system can become national or global. Scale increases responsibility. If a firm is large enough that its failure can harm the world, then its private decisions are not fully private. This is uncomfortable for markets built on private enterprise, but systemic importance changes the moral equation. A giant financial firm cannot say its risks belong only to itself if its collapse can freeze credit for others. That is why regulation becomes necessary. That is why capital matters. That is why liquidity matters. That is why resolution planning matters. The larger the institution, the less room it has to treat fragility as its own business. Lehman was large enough to matter. It was not protected enough to fail safely. It was not disciplined enough to avoid the edge. It reached the edge and fell into everyone else's weather. The image of weather returns because finance often behaves like atmosphere. Confidence rises like pressure. Fear moves like a front. Liquidity dries like a season. Storms gather in one market and break in another. People far away from the first disturbance feel the rain. On September 15, 2008, the weather changed. The sky did not darken literally. People still walked to work, coffee was still poured, traffic lights still changed. But the financial atmosphere shifted. And once it shifted, everyone had to breathe it. The final file is therefore not only about Lehman Brothers, it is about the atmosphere that allowed Lehman to grow fragile, cheap credit, rising homes, yield hunger, model confidence, rating dependence, short-term funding, high leverage, weak oversight, delayed recognition, emergency uncertainty. Each element was a current in the air. Lehman moved inside those currents. It also helped strengthen them. When the storm broke, the firm became the name attached to it. That name now sits in the archive with unusual weight. Some files are warnings about fraud, some are warnings about fantasy, some are warnings about charismatic overreach. This one is a warning about systems. Systems can fail even when many people inside them are intelligent. Systems can fail even when each participant sees only a reasonable piece. Systems can fail because the pieces fit together in a way no one can safely absorb when conditions change. That is why humility matters. Humility in modeling, humility in lending, humility in regulation, humility in leadership, humility in the face of markets that have risen for too long. Humility does not mean paralysis. It means remembering that the system is never fully known. It means holding capital against surprise. It means planning for failure before failure becomes visible. It means listening carefully when one number does not fit. For Lehman, too many numbers did not fit by the end. The real estate marks, the leverage, the funding dependence, the market signals, the failed capital discussions, the downgrade threats, the absence of a buyer, the Sunday night without a solution. Each number, each signal, each silence pointed toward the same conclusion. The old institution could no longer carry the risk it had gathered, so the court received the filing, the market received the shock, the economy received the consequences, and history received the name, Lehman Brothers. The file can rest now. It has been opened carefully. The cotton has been traced to the mortgage to the security to the balance sheet to the run to the bankruptcy to the recession to the household back to the simple need that began the chain. A home, a place to live, a promise to pay, a belief that the promise could be transformed, sold, rated, leveraged, and made safe. The belief was too large. The promise was too fragile. The transformation was too confident. The safety was too thin. Now the lights in the archive dim. The markets outside are closed for the night. No ticker moves. No trader calls across the floor. No weekend rescue is being assembled behind locked doors. Only the file remains. Heavy, quiet, precise. It says that risk can sleep inside prosperity. It says that debt can travel farther than responsibility. It says that old names can fall. It says that when confidence leaves, even the largest rooms can empty quickly. And then it says nothing more. The lesson has been filed. The building is quiet. The morning has passed into history. Yet history is not only what happened, it is what keeps happening differently. After Lehman, markets did not stop creating confidence. They had to create it again. Every loan made after the crisis required some renewed belief. Every bank deposit required trust. Every bond purchase required a judgment about repayment. Every mortgage signed required a borrower and lender to imagine a future in which income, prices, and time remained manageable. The economy cannot live without such imagination. The lesson of Lehman is not to stop imagining. It is to stop mistaking imagination for proof. The distinction is small in language and enormous in consequence. Before the crisis, many people imagined that national housing prices could not fall severely. They imagined that diversification would protect mortgage pools. They imagined that AAA ratings could carry the weight placed on them. They imagined that liquidity would remain. They imagined that large firms would find buyers. They imagined that the system had become too sophisticated for an old-fashioned panic. Each imagination had a model, a chart, a precedent, or a professional explanation behind it that made it feel like proof. It was not proof, it was structured hope. Finance runs on structured hope. A loan is hope with a payment schedule. A bond is hope with covenants. A mortgage-backed security is hope routed through thousands of households. A bank balance sheet is hope arranged by maturity, capital, and trust. There is nothing wrong with hope when it is disciplined. The danger comes when hope is leveraged, rated, resold, and treated as certainty. Lehman was a house of structured hope, standing in a storm of its own era. When the storm came, the structure was not strong enough. The final moral is therefore not anti-finance. It is anti-forgetting. Forget the borrower, and the loan becomes product. Forget the loan, and the security becomes abstraction. Forget the security, and the balance sheet becomes performance. Forget the balance sheet, and the institution becomes a name. Forget the name can fail, and the system becomes dangerous. Memory must move in the opposite direction, from the name back to the balance sheet, from the balance sheet back to the security, from the security back to the loan back to the borrower, from the borrower back to the house, from the house back to the simple fact that every financial structure rests somewhere on human capacity. Capacity to pay, capacity to work, capacity to trust, capacity to absorb loss. When finance forgets that, it begins to float. For a while, floating feels like flight. Then gravity returns. Lehman was gravity returning. It returned to a firm that had survived for generations. It returned to a market that had confused motion with safety. It returned to securities that had been built as if risk could be sliced into obedience. It returned to policymakers who had to choose among failures. It returned to families who had never seen the trading floor and never would. The file is quiet because the noise has already happened. The shouting on trading desks is gone. The emergency calls are gone. The hearings are over. The immediate panic has passed. What remains is the shape, a long rise, a hidden weakness, a set of warnings, a narrowing corridor, a weekend without a door, a Monday morning that changed the world. This shape is why the file stays in the archive, not to keep the past frozen, to make the next warning easier to recognize. Somewhere in another market, another assumption may be growing old without being questioned. Somewhere, a model may be treated as reality. Somewhere, leverage may be rising because recent history has been kind. Somewhere, a safe asset may be acquiring risk quietly. Somewhere, people may be saying the system is different now. It may be different, but difference is not immunity. That is the last sentence the file wants to leave behind. Difference is not immunity. Sophistication is not immunity. Age is not immunity. Size is not immunity. And confidence, however necessary, is not the same as truth. Now the archive is still. The documents are back in order. The bankruptcy petition rests beneath the old history of cotton, railroads, mortgages, ratings, and markets. The morning of September 15 sits on top like a final page. Outside, another financial day will come. Prices will move, loans will be made, risk will be measured. Some of it will be measured well, some of it will not. The file cannot stop that. It can only wait. Quietly, patiently, ready to be opened when someone asks why the room once believed it was safe. And when it is opened, the answer should not arrive as a slogan. It should arrive as sequence. First the home, then the loan, then the pool, then the rating, then the security, then the leverage, then the funding, then the doubt, then the run, then the weekend, then the filing, then the recession. That sequence is the real warning. Collapse rarely begins where the public first sees it. By the time the name appears on the screen, the story has already traveled a long distance. The quiet work is to notice the travel earlier, to ask where risk has gone, to ask who is holding it, to ask who can survive if the assumption fails, to ask whether the people earning the fees are also carrying the loss, to ask whether safety has been proven or merely repeated. These questions do not sound dramatic. They sound like paperwork, they sound like risk committees, they sound like dull meetings in rooms without cameras. But dull questions can protect the world from dramatic mornings. That is another lesson in the file. The boring work matters, capital matters, disclosure matters, loan standards matter, liquidity planning matters, accounting judgment matters, regulatory patience matters. So does the willingness to be unpopular during a boom. The person who says no early may look foolish. The person who says no late may be ignored. The art is knowing when the music is too loud for the room. Lehman did not know in time, or did not act in time, or could not make itself believe the time had come. The distinction matters less than the result. The firm fell. The system shook. The lesson entered history. Now the room is quiet enough to hear it. Risk that cannot be seen is still risk. Debt that has been transformed is still debt. Confidence that depends on silence is already fragile. And a name that has survived almost everything has not proven it can survive anything. So the file closes one last time. The pages settle. The archive light lowers. The markets sleep. And the old building stands in the dark, no longer promising safety, only reminding us how carefully safety must be earned. That earning never ends. It begins again each morning, in every loan reviewed honestly, in every model questioned carefully, in every balance sheet read without flattery, in every meeting where someone is allowed to say the number does not fit. Those small acts are not famous. They do not appear on the front page, but they are how systems remain standing. Lehman is what happens when too many small acts arrive too late. The file rests now with that quiet warning, and in the silence after the warning, the lesson remains simple enough to carry. No institution is safer than the risks it chooses to understand. No market is stronger than the trust it deserves. The archive remembers what the market tried to forget.